come and join us for our workshop. Looking forward to hear from him the company that there is the company industry.
Okay. Thank you. It's quite a technical topic that I'll try to make as low technical as possible. So I even start off with a cartoon to show you I do enjoy the math, but it's not too mathy, hopefully. Hierarchical optimization is a optimization framework that utilizes graph-based machine learning. Okay, so effectively we try to add an element of supervised machine learning to the concept of portfolio optimization. What is portfolio optimization? When we manage funds, so I manage our balance funds, our high and low equity balance fund, as well as a few of our bespoke or funds that we manage on a segregated basis. And when you manage multi-asset strategies, you have the ability to invest in equities, bonds, commodities, the whole shebang, local, offshore, et cetera, et cetera. And how do you actually determine what is an optimal asset allocation? Right. So standard theory is, or how it's standardly done, is using mean variance optimization frameworks. That's kind of the bread and butter of optimization. But there's a more nuanced way that we can actually do this. And I'm going to try and convince you that the covariance matrix should not be regarded as a flat two-dimensional object, but that there's actually a potential third dimension to the covariance matrix that gives you a richer set of information when you optimize. Okay, that's the premise behind the work. Since we've written you can get the working paper there just by scanning that. It's on SSRN, so we are we've submitted that to a high-end journal, and with that, it's a long process. But with the working paper, we've had great feedback. We've had several teams already using it. One team sits in Boston, one team sits in London. The Slovenian Central Bank use it now, and we get feedback from a lot of these teams using the algorithm that it works very well. We built a coding base of that in R. That we do make available sort of on an ad hoc basis. We don't yet want to dump the code somewhere on the internet because, like I said, it's still in the publication phase, and there might be some tweaks we're going to make to it. But certainly, this is work done by a previous student of mine and an erstwhile colleague that finished his PhD in Hamburg, Johan Fitzinger. Him and I still work together on several projects. We've developed a few R packages and stuff like that. So we continue to work together, and so we want to just get the paper published at some stage, and then we'll make the library, the R library that we have available. We've made it super easy to actually implement these optimization frameworks, and so the teams that have used it, we've used as kind of guinea pigs to see if it is actually usable, and it is, and we're quite excited about this framework. Okay, so basically, I can just show you this slide and I can go sit down because this encompasses what we do. So we remember when I was still president back in the day, we used to get a cartoonist to draw some of our research because research can be, if it's just a bunch of math, you tend to lose the intuition. So what we tried to do is just I gave the guy kind of a very simple brief of what we're trying to do. So if you forget the math, you'll remember the graph. It's about saying, well, diversification in a portfolio is about putting your eggs in different baskets, right? We all know that. Your grandma knows that. It's a common concept. Don't put all your eggs in the same basket. Well, the problem is our traditional concept of diversification is putting your eggs in different baskets, oftentimes ending up on the same vehicle. Now, if all of your eggs are in different baskets, great. But if it's on the same truck and that truck overturns, well, there's your benefit of diversification down the tube, right? So the true nature of diversification is finding different uncorrelated vehicles and determining how my basket should be spread across vehicles that are statistically distinct from one another while still achieving a global objective, be it max diversification, maximizing returns, whatever your global objective is. All these vehicles need to pull in the same, drive in the same direction, but you need that true source of diversification. Okay, Now let's do some just basic background in terms of optimization. So since Markowitz's seminal work, we know that optimization is about finding a weights vector so that you minimize risk while maximizing return. This is the real simple stuff. Yes, but it's sensitive to measurement error. Your sample covariance is extremely noisy, and returns have a very low forecasting power. We know that, right? So that's unfortunately part and parcel of what we do is, for example, your returns, you don't just look back and project that forward. You have to have a kind of a very detailed bottom-up view of forecasting returns, which we do. This we do at Sanlam when we build our SAA framework. Then yeah, we have quite a nice means of building return forecasts. But the big issue remains your covariance is very sensitive to noise. Okay, now risk parity or vol-based techniques that don't require return forecasting, but just focus on mitigating risk. Problem is, it requires a positive semi-definite matrix, which, I mean, if you've ever done optimizations, you know that you very quickly run into, matrices that cannot be, that's not positive semi-definite. You run into that problem. You also fall prey to Markowitz's curse, right? So the larger the n, the larger your error space. And so, I mean, it's typically called Markowitz's curse. I think of it more as Markowitz's irony, because typically adding more correlated stocks or asset classes means greater need for risk diversification. The more n you add, the more you need to diversify, and so that starts to lead to unstable solutions. Okay, we're not going to get around that. Now, very simply put, you look at your different optimization choices, your menu. You always have a trade-off between simplicity and estimation risk, right? So the more complex it becomes, the more you run into estimation risk, right? So and the more the noise gets introduced. So very simple, equally weighted 1/n. You don't have any noise. You're not introducing anything. Very simple, but also it doesn't achieve much, right? By nature of diversification. I also teach a course at Stellenbosch, and the first thing that I always ask the students is, when you look at a 1/n portfolio, is that a well-diversified portfolio? And intuitively, you think, yeah. I mean, the bigger the n, the better your diversification. Index like the MSCI World that we manage, I mean, there's 2,000 stocks in there. So your conclusion should be that's a well-diversified index, right? But the problem is 1/n can be extremely concentrated in terms of risk. You have 100 stocks, you weight them each, allocate 1% to each. If 99 of those stocks have a correlation close to 100%, well, that's an undiversified portfolio. You'd be better off holding 50% of one stock and 50% of the other 99. So the point is 1/n doesn't really get to the problem of the potential for overlap of information between your stocks. You have naive risk parity, robust risk parity. I'm not going to get into those. Autoencoders, really cool new technology in terms of optimization. We are looking at this as well. With neural networks aimed at reinforced learning. It's effectively, think of it as it's reinforced learning, right? So it has a forward loop, a backward revision, and so you kind of have a nice, circulation of information effectively. And then stock standard mean variance type estimation procedures. The problem is, well, the benefit is, you now have returns to supplement your optimization. The only problem is, like I mentioned earlier, your return estimations are quite, inaccurate on the best of times. Okay, so how do we deal with noise in the covariance shrinkage, right? So the covariance matrix in and of itself, let's start there. Problem is, like I highlighted, your covariance matrix tends to have a high noise dimension. And so how do you reduce noise while preserving signal? There's various bootstrapping techniques, your Ledoit-Wolff techniques that shrink your covariance matrix and try to reduce noise, amplify signal. All of those, I mean, there's a big literature on this. Your shrinkage methods are, I mean, they're interesting, and they do work in certain circumstances. They dramatically fail in other circumstances. You have factor-based regularization, where you try to impose on the matrix a sense of what should be determined as signal. And then you have covariance regularization using those autoencoders that I mentioned. again, reinforced learning that tries to get better information out of your covariance matrix. Two problems with the typical techniques, right? The first is you're generally not able to deal with nonlinear risk too well. What I mean by that is if you have an information set that looks like that from a two-dimensional perspective, well, if you turn that cone on its head, it can look like either of these pictures. You won't know, right? And so the thing is, when we look at a covariance matrix, we think of it as or we traditionally determine it as a two-dimensional flat plane. We don't have information sets about characteristics in my data that might skew things that depending on my vantage point, right? And if we go back to what I mentioned earlier about diversification, the problem is treating a covariance matrix as a flat two-dimensional object doesn't really tell us much. Doesn't really tell us much about statistical relationships that might exist in my data that's not clear in the two-dimensional plane. Okay, that's the first problem. The second problem is, this is a spectacularly, dramatically underserviced problem in the literature. I see very few authors mention this, and this is that separating noise from signal typically is separate from the global optimizer goal, which, guys, think for a second, makes no sense, makes absolutely no sense. If I say I'm going to shrink my covariance matrix to reduce noise and amplify signal, if I don't define what is signal, what am I doing, right? So in other words, we need to first ask the question, what am I trying to achieve? What am I trying to get out of my covariance matrix? And then shrink noise and amplify signal. I can't do that at the outset without guidance, right? It actually doesn't make a lot of sense. And blunt ways of doing it, I would argue, throws away a lot of information at the cost of reducing noise. Okay, but there's no doubt that we need to separate noise from signal, especially in, like I mentioned, typically ill-derived covariance matrices. But identification should it not be governed by a global optimization? And so typically how we do things, we have a distribution assumptions, right? We estimate our covariance, then we apply shrinkage, and then thereafter, after I've cut the noise, then I go and I optimize. Think of it, a mean variance optimization for a portfolio. What we do is start off with the data, estimate our covariance, then we shrink it, i.e. arbitrarily define what is noise and what is signal, and then I go, let's reduce the noise, arbitrarily, right? Without consideration of what's my goal. Thereafter, after I now have a clean covariance matrix, then I optimize information. That's unrelated to my global optimizer goal. But think of it, shrinkage should ultimately be done with the ultimate goal of maximizing returns, might differ completely compared to maximizing diversification, minimizing risk. If my goal is to maximize return, what I treat as signal and noise differs than if I want to actually just maximize diversification, minimize risk. Different goals, different determination of what is noise and what is signal. Okay. So what if our optimizer could filter noise in a way that takes cognizance of global optimizer objectives? Secondly, more fully utilize the information contained in the covariance matrix. In other words, not treat it as a two-dimensional object, but as a three-dimensional plane. Okay, what if we treat the covariance matrix as a 3D object so that I can account for the layers in my data? And what if we could build a proper risk source diversification into the optimization process? Actually identify what are sources of diversification, i.e. what are the different vehicles, statistically speaking, that I can put my baskets of eggs on. So can clustering help? So clustering algorithms group series through common statistical features, okay? So i.e. the goal is statistically to maximize intra-group similarities and minimize intergroup similarities, right? So in other words, I want to have a cluster that is sufficiently similar, but between my clusters sufficiently different. So as much difference between the clusters as similarity within the clusters. Okay, so here I just colored to show you, I took the top 40 index, local top 40 index of stocks, and I just said, well, let's cluster it using a dendrogram like this. And you might be familiar with these, but basically what it is, if two stocks are similar, their intersection is low, and if two stocks are more dissimilar, their intersection which stocks are most similar. So in the top 40, unsurprisingly, the most similar stocks are Investec Limited and Investec Proprietary. Okay, the one trades in London, the other trades primary listing in London, others primary listing is in Joburg, but effectively they're the same company. So you would expect their share prices to be very similar, right? So there will always be some differential, but I mean, you know, effectively still the same company. So their intersection is very low because they are very similar. As you climb up the tree, it now looks for the next adjacent pair of similarity. Again, their intersection to be low. And as you climb, it either looks for another set of stocks to pair these groups with, or pair it across a completely different sectoral dimension, for example. So you typically see your financials clustered together, your resource stocks clustered together, et cetera, et cetera. How do we use this information? Because it's telling me something about the similarity of assets in my portfolio. The more similar they are, the lower they intersect. Is that information that we can actually use? Now, a very simple mean variance optimizer, think of it, and guys, this is 98% of portfolio optimization uses mean variance optimizer. So I'm talking about the majority of techniques would look at this tree and go, oh, that's moderately interesting, but I'm going to throw away all of that information. I only look at the last node. In other words, how close these stocks are to one another. That's it. The rest of the dimension I just throw away. I treat the covariance matrix as a flat plane, effectively at the last node. This is the only information that I want to utilize my optimization thing, which makes no sense, right? Because there's a rich set of considering. Okay. So the idea is to somehow utilize this tree structure. So Lopez de Prado, not sure if anyone is familiar with the guy. Okay, so World Quant of the Year, quite a few years. He wrote the paper HRP, Hierarchical Risk Parity, which he said, let's use this tree structure in our optimization techniques. And this is when the paper came out, I read it, and it was really interesting, right? It's like, you got me there in the first half. Practicality of the technique. So he says, what if we could use this in portfolio optimization? Then in the most lazy way possible, he says, well, let's just apply risk parity and get on with it. It makes no effort really, in truth, of fully utilizing the information set available and actually allowing flexibility in terms of how you utilize this tree. Just says, let's apply risk parity from a top-down perspective. Yeah, so it's almost like you're onto something, but then didn't fully execute. And it was at this time that I gave, Johan was still a master student, we conceptualized the problem statement in terms of generalizing this framework, and then, giving a of tree-based or graph-based machine learning algorithm to do portfolio optimization. So he did a thesis, master's thesis on it, and we kind of developed through time an algorithm that allows us to more flexibly consider the process. So what did Lopez de Prado say? Well, he said it's very simple, right? So it's cool. It's a tree. We've got a tree. It's a pretty tree. And let's say you have 100 Rand that you want to allocate optimally across different dimensions of this tree. And he said at each node, so at each intersection, we call a node, right? At each node, starting from the top, we take 100 Rand and then we split it based on risk parity. That's it. Okay. So, risk parity, 65 Rand should go right, 35 should go left. And then you carry on like that. The next node, well, of that 35 Rand, 20 Rand goes left, 15 Rand goes right, 45 left, 45 right, carries on and on and on like that. So really simple. The question is how useful is this, right? Because me as a practitioner, I can look at this and I can go, great, but that's risk parity. I can't introduce my return forecasts. Now, you've lost me, right? If you introduce an optimization framework that says, sorry, but you can't include any return forecasts, you lost me. I mean, how can I as a practitioner use an optimization technique if I can't say, this is my return forecast for these asset classes? It's completely impractical, right? Or constrain it further and say, I don't really care about risk parity. I don't regard that as a useful means of saying I want to have 2/3 of my assets going right. because risk parity is a blunt instrument for doing this, but it kind of does the trick. So it's simple and intuitive and incorporates a hierarchy. That's great, but the problem is it's crude. It's unsupervised. I can't impose what I regard as considered here. There's no kind of Pareto optimal. It's simply just going left and right based on risk parity. Can I impose constraints? Like I need to maximally hold 20% in banks. There's no way that you can impose constraints. Like, again, it's almost like you had me there for a while, but then it's like this most unpractical algorithm that literally no one can use. And it provides no insight into performance. It's a very odd, way of actually utilizing the tree structure. Now, several derivatives have emerged on that, and if you're technically minded, throw new techniques. But really, the add-ons to this technique was extremely basic. So NCO, HMV, several others adds. The idea is that the structure can add a third dimension to your covariance matrix. I want you to think of it this way. That's a typical shrunken covariance. That is, if I look at my covariance matrix and I shrink it using Ledoit-Wolff, you're going to get to something like that, where the darker the color, the higher the covariance numbers. Of course, your diagonal is going to be 1. That's a dark positive. And then, off diagonals will be either dark blue, positive, or red. But what we try to do is to say, well, that's our flat two-dimensional domain, but we want to add this risk source dimension to our covariance matrix using a tree structure, right? So build up different layers of the covariance matrix. Practically, what we're doing is we apply a bird's eye view to filtering. So if you think of the top of the tree, there's only 2 or 3 dimensions. And so my covariance matrix requires kind of lesser shrinking, if you like, because there's less dimensions to shrink. It's almost like an MRI scan, when they cut through a body through an MRI. So you can take the tree structure from the top, you can start cutting through your covariance matrix until you're left at the last node, which is effectively diagonals plus just the ordering of your variables. So not too much to read into the last information set. Now, the CHI algorithm that we propose, so that's a convex hierarchical optimization framework. It's a generalization of utilizing this with an added dimension that you can add a lot of flexibility. I'm going to show you the flexibility that we can add. So really the idea is that funds are first allocated to very general clusters of assets, and then we progressively refine the allocation as clusters increase, okay? So think of it this way. So these are my nodes, right, for my tree, and I can write that mathematically simply as saying, well, okay, so in the first node, if I have 4 assets, you can see there's 4 assets at the bottom of the tree. That means the first row is the first node, and there I have asset A, B, C, D, all in that row. The second node only has asset A and B, so it's got 1, 1, 0, 0. Third node has 0 A and B, 1, 1 for C and D, and then the last node just has each of the stocks in their own node. So we just rewrite the graph as a matrix. And once we start to do that, well, now we can actually start to use mathematically define what it is that we try to achieve. Okay, so the principle of applying graph theory into optimization is novel and appealing, but with obvious shortcomings, right? Like I mentioned, I mean, it's just a brainless way of allocating assets across the different nodes. What we try to do is to generalize this framework by allowing flexibility in the following. Intra-cluster optimization, that's the first step. In other words, how do you optimally allocate between these 2 clusters when it splits? How do you optimally allocate between that? That we call intra-cluster optimization. Then, as a second step, we allow inter-cluster optimization. So once you've defined your cluster assets, how do you optimize them? But think of it as reaching this point, going left and right based on some optimization, not necessarily HRP. So we allow flexibility at that point to say we want to allocate based on max diversification, based on minimum risk diversification, based on return optimization. Whatever your objective is, you can define your objective that goes left or right. Once you've gone left or right in this new node, the Prado just does an equal weighting. Again, it's bizarre. There's no point that equal weighting is optimal at that point. So we say you need flexibility at this point for intercluster optimization to say, well, think of it as me having a portfolio now there. Think of it as this is a new portfolio that only has these stocks. How do I optimally allocate between them? And how do I optimally allocate between them? In other words, think of it this way. When I start my journey, I walk down the street, okay? Now I say, well, optimally, how much should go left and right? That is the first step. That's my intra-cluster optimization. Let's say that's based on max diversification. That's it. I just want to be maximally diversified at each point. Step one. Step two, once I go left or right, these are my assets. How do I optimize them? Well, now I want to use a mean variance framework with my return forecasts. Cool, then I've done that. And then the third step, and this is the hardest step, and I think this is why most of the literature on this completely avoids this step, because it is actually quite a complex step conceptually to apply this. How do you collapse this structure into a weights vector? How do I go, well, okay, I've now built, think of it, I've built a optimal portfolio at each node. So I effectively have, 100 or however big a tree structure, optimal portfolios at each node. How do I now collapse this into a single weights vector? Because obviously a portfolio manager can't have, these theoretic weights. I need to actually go, I need a two-dimensional weights object to actually build my portfolio. So how do I collapse this down into a tree structure? So we then, as a third step, so we've added flexibility in terms of intra, inter, and now the collapsing of the structure can have its own global objective, okay? And we collapse that structure into weights vector, embedding global portfolio objectives with constraints using a loss function that provides a convex set of optimal points for the different shrinkage methods, i.e., and we actually thought a lot about visualization in our paper. We gave it good thought because and one way that we showed this is actual data on a portfolio that we optimized. We say, let's color these little bars to tell you how much information is new relative to the previous sets. In other words, what new orthogonal set of information is being added by each node. And so if we have a split like this, that doesn't really add any new information. In my final weights vector, I should downweight this split. So that's not adding much new information. This one adds a lot of new information. In other words, there's a risk source that it has identified that's sufficiently different from my preceding nodes, and I want this to weigh more than that one, based on my global objective. I change my global objective, these colors will change. Okay? So in other words, if my global objective is to maximally diversify across assets, then this is an important node. If my objective is to just maximize return, this is not an important node. See, we allow flexibility in terms of how you collapse the structure to have a global goal in mind for separating risk and noise. Information and noise. So phi, that's a variable that determines how much of each level informs the global optimizer. And in this way, shrinkage is flexibly determined with a global objective in mind. Okay, so in other words, we have our phi variables multiplied by the tree structure and the alpha weights, and then we get a single weights vector at the end. Okay. But the cool thing is this global objective function, in our paper, we suggest a few that have different objectives, right? So the intra-cluster and the inter-cluster, I mean, effectively these use standard optimization techniques, really, off-the-shelf one that you can plug in. Doesn't really matter. But the collapsing of that tree structure into a single vector, we suggest a few ways to do this that has different global objectives in mind. So the first one that we suggest is just global max, or using max diversification loss function. So you want to be optimally diversified in your portfolio. So internally, the tree structure optimizes using, let's say, mean variance. But then how I collapse all of that is to say each node must only contribute to my final vector based on an objective of being optimally diversified in my portfolio. Okay. So then we suggest using that global loss function to determine effectively the colors or the weights that's of the structure. And so this would differ from, for example, this equal risk contribution. So this one says I want to be maximally diversified. This one says I want to have equal risk across all the nodes in my covariance structure. Okay. So think of how these two differ. So this third step, if max diversification is my objective, then while the level-specific intercluster weights are optimized using, for example, whatever, mean variance, the meta optimizer ensures that each level contributes only to the extent that it adds meaningful diversification. Each node in the collapsing, that color is determined solely by whether that node meaningfully adds diversification to my portfolio. If ERC was my objective, then each color collapsing into my final weights vector ensures that each level contributes only to the extent that risk is equally distributed across each of my risk clusters. Cool. So, yeah, I think for time's sake, let me move across. Then we did a lot of analysis or a lot of bootstrapping, as well as applied it on actual data just to show that what kind of characteristics we can achieve using this optimization framework. The optimal hierarchy, in other words, how we collapse that tree structure, automatically regulates the size of the portfolio when the degree of correlation in the universe increases. So we actually show it's robust to Markowitz's curves, which stuff like Ledoit-Wolff and other forms of shrinkage is not immune to, right? We show that as your correlation increases, so your max diversification benefit adjusts for that. Okay. Then we also show that if your correlation increases, so we literally increase it, you can see that the importance of this tree, the structure gets pushed down, versus if there's more dissimilarity in my data, the structure of the tree increases. And we actually show in the paper, you can go crazy and say, all my stocks are effectively the same, in which case the algorithm will adjust so that your tree is not useful. Think about it, if I have 20 completely independent stocks, the tree structure is of no use. Right? And so the information set utilized in my tree structure actually gets pushed down, meaning the ultimate, the end goal is not really informed by the different clusters. Whereas the more dissimilar my stocks are, the more important it is to consider the tree structure. Okay, then we ran some pretty cool backtests that we kind of explained how you can think of this algorithm, what it can do in your portfolio. So the first backtest was run on multi-asset data, where we compared the performance of CHI with max diversification and ERC structure. In other words, we say, well, how does this portfolio do on actual real data when running the optimization using the tree structure and the global objective of max diversification versus just applying max diversification? Okay, so in other words, what traditionally is used as an optimizer versus considering the tree structure, and on every single metric, there's a significant improvement. So this is now based on, okay, yes, it's a bit much in terms of information, but on every single measure of diversification, it sees substantial improvement, okay? Which means you're getting risk reduction benefits to it. And here's the key, without paying away in terms of return. So, which, that's part of the problem oftentimes with these optimization algorithms. As soon as it's not return-based, you pay off return. So in other words, you're well diversified, but it's a rubbish portfolio, right? What we say is, by virtue of actually including that return estimator in the optimizer, the tree structure optimization, we're actually able to improve portfolio return and efficiency while achieving a higher form of diversification, because it is proper diversification. So it's having your cake and eating it, so to speak, from a portfolio construction perspective. What we do here, and I think that it is quite novel, here we just apply it on normal data. What we do here is we actually build informed fund managers. In other words, managers with better than zero information. Because here's the problem, right? When we as practitioners read a paper, I read a lot of technical papers and I go, oh, this is interesting. But then you look at the application section and they say, we see if it can improve the returns of random portfolios. And I go, but we don't manage random portfolios, do we? So what's the point, right? For me, it's called comfort saying, oh, this algorithm would have beaten a 1/n portfolio or a random portfolio. I mean, we're not random, right? So what we actually try to do in our application section, I wish more papers would do this, because it's going to appeal so much more to practitioners. Design a clever portfolio manager that's a clever monkey. not just monkeys, right? Random monkeys throwing darts at a board, giving you a portfolio is not useful. Give me a clever monkey, right? In other words, your information set is better than random. And then say if your optimizer can improve the results of a good manager. Because every manager reading your paper, in their mind, will be at least a good manager. But that's true or not is irrelevant. They're not going to be in the business of managing portfolios if they are objectively poor at doing so. So they regard themselves as knowledgeable. So I need to convince someone that's knowledgeable that the knowledgeable monkey would be better off using this optimizer. Just, yeah, anyway. And so the way we do that, we explain the paper, we add knowledge to the random portfolios, and then we show even with knowledgeable portfolios, you add significantly higher diversification. You want to be lower here, you want to be higher there. So you still add meaningful improvements in diversification, key without paying in performance. In other words, you're not reducing your performance overall, you're actually improving performance. Better diversified with higher performance. Now, I know all of you kidding, but let's say all of you are now shouting at me, yes, but you're using it on the last 20 years of data, and risk source diversification wasn't as important in the last 20 years. That's 100% right. Because in the last 20 years, being diversified was actually probably not to your benefit. Right? Asset classes co-moved massively. You had effectively a Fed put in place. So, whenever equity markets correct, Fed steps in. Now, that was in the past. So proper diversification wasn't as important in the last 20 years. So what we now do for the next paper, and I have one of my previous students built an algorithm that produces, using copulas, proper universes of stocks that have periods of concerted downturns. In other words, if one stock has a downturn, the systemic risk in our universe increases randomly. And so the importance of identifying risk clusters is important in that synthetic data set. And we're going to show in that data set that these numbers will look even better if you enter a world where risk diversification is more important. Okay, so just in conclusion, I'm done. The benefits of flexible graph theory optimization framework is the second moment, contains, in other words, the covariance, contains a lot of useful and persistent information, especially compared to the first moment, yet we throw away almost all of it. And we'll be better informed by statistical sources of risk, properly diversify portfolio. But we need to, in order to do this and get practitioners to use it, your modeler needs flexibility in terms of how you reduce the noise, not just in a blunt way, but actually in an informed way. What do you regard as noise and signal? And then adjust your covariance matrix accordingly. And it allows you to achieve better risk diversification without paying away performance. Because again, no practitioner is going to be happy to say, oh, well, I mean, this portfolio performed rubbish, but at least it was well diversified. And that's of no use, right? The benefit of diversification cannot come at the cost of performance. Wish academics can understand that, because it's really irrelevant if it doesn't work. But at least, in hindsight, you were well diversified. I mean, that's not of no use. Further work, designing, like I mentioned, this counterfactual history using copular frameworks where proper risk diversification is really important. That's ongoing work that we're doing. We just first want to publish this paper and then go into the next sections of the paper. And yeah, I think that's going to better help show that. Okay, that is the paper. Like I said, I'm not going to share the code unless you convince me why you want to work on the code yet. We have shared it here and there, but that's more like guinea pig. The problem that we face is, and you have to understand that, is if I just start haphazardly sharing the code, problem is if we get feedback from the referees, which we have had several detailed feedbacks on it, then we have to amend the code, and then I have to mail people to say just change this or that. So at the moment it's still relatively in flow, but I have shared this with a few guys, but at least it works very well, and you'll see that it nests a lot of the different optimizers. So maybe as a last throwaway point, the beauty of this is, think of it this way, this last step, right, effectively means if you have no tree structure, your global objective was max diversification. So reason with me. Your portfolio objective is max diversification. You have no tree structure, or you set this phi parameter to 0, you get max diversification exactly. So it nests all the optimization techniques that you know. Mean variance, it nests that. You just set phi to 0 and you get mean variance. As soon as you increase phi, in other words, you increase how much of this tree structure you are considering, then you literally start to deviate from max diversification to include all of these other information sets that your covariance matrix has. So it nests all your traditional measures. So you can always compare two outputs by saying, this is the weights vector that I get through my mean variance optimizer. This is the weights vector that I get through my mean variance optimizer, but also considering the third dimension of my covariance matrix. Okay, that's it really.
Yep. Any question to Nico?
Yep.
Just to confirm my understanding here, so this hierarchical subdivision, right? So you're subdividing into different groups, and of course, when you have two groups at the same level of hierarchy,
yep,
then some assets, let's say some stocks in one group, will be more correlated with the other group than others, right? So it's not homogeneous.
Just again, so let's say I add a node that splits, right? Is that what you mean? Then the one group you're saying there's homogeneity between the one group and the other group.
Well, there's not, right? In fact.
Oh yeah, you want to maximize your different groups as differential.
This is just setting up my question, right? So
right.
So you have, let's say, two groups of stocks at that level of hierarchy. They've got 50 stocks each in them, right?
Yep.
But each one of those 50, out of those 50, right, there'll be some that are closer to the correlation to the other group than not. So that obviously will affect, depending on how you then allocate further down, that's going to affect your total diversification. And it does your global objective when you get to your weightings, does that take that into account?
It would take that into account because at each node split, it's going to identify what source of information is added to my previous set of information. So to your point, if there's a lot of similarity between the groups where there's a split, in other words, there's a lot of overlap, that split is not going to add much information to my global objective. And so I'm going to weight that node less. There's a lot of overlap in information. There's a lot of similarity that will be reflected either in that step or in the next step. It's not going to repeat that information necessarily. Does that make sense?
Yeah, I'm not sure quite whether that's what I was trying to ask. So let's say you have two banks in one step, and then you have three mining companies. Right. And then one of the banks actually lends to mining companies, and the other one doesn't.
Okay. So that, yeah.
So then obviously, if you've got some mining companies in your portfolio, you get more diversification.
Yeah. Sure.
So is that actually somehow then going to enter into the optimization?
I see. That's a good question. So in other words, there's going to be, so here's the problem, right? There's going to be some information that's not contained in typical covariance, like co-movement in returns. To your point, if two assets are closely linked through, let's say, a debt agreement or whatever the case is, if that's not reflected in your tree hierarchy, then yes, that's not going to come through in your final weights. Probably not, because unless we're kind of constrained by that tree hierarchy structure in terms of how that information is filtered through. But I would argue that that information is also not going to be reflected in a traditional optimizer. You're not going to be aware of that unless you deviate from your optimizer to add information like adjust your covariance based on that knowledge.
Well, to the extent that the bank that lends to mining companies is recognized by your covariance estimation will be more correlated with mining.
But how would you recognize that?
Well, but that bank have a higher correlation with the two mining companies when you're just looking at the covariance matrix straight, right?
Right.
No clustering.
But that closeness, that proximity, right, would be reflected in your tree structure at some point. At some node, it will be reflected, right? Okay. And so that's kind of the point, right? Is when you collapse your tree, you can't do it on an equal weighted basis. So think of a higher HRP, MVO, like all the current utilization of graph-based theory and optimization currently has no proper way for collapsing those nodes. In other words, they treat each additional node as equally important. But that makes no sense, right? Because sometimes the nodes split into meaningful splits. And how do you determine meaningful? Well, you have to have a global objective. If your global objective is to say optimally diversify, then at points your node splits into a more different split. That makes sense. And so at some point, I believe your information will be reflected in that tree structure. And hopefully at that point, the global optimizer will pick up that that's an important split and will then weight that split higher in your ultimate weight vector.
I guess the way to check that is if you can actually write your splits in terms of conditional independence between groups, right? Then you can get it in a way that you can actually mathematically prove that it's being properly taken into account.
Yeah.
But I guess that's nobody's done that yet, right?
No. Yeah, it's so I would almost say we need to maybe put in a few dummy variables to say, does it pick up that closeness? And that's why we need the synthetic data. That's why we're building data that has risk clusters in them implicitly through copular frameworks to say these set of stocks have periods of extreme high co-movement, and we then want to see whether it actually maps into those different clusters. Okay, but yeah, interesting point. Any other comments, thoughts?
Yeah. Emma?
So how does this compare to something like the minimum spanning tree in terms of hierarchy? Because with the minimum spanning tree, you also break them down.
Yeah.
To those some sort of relative distance.
Yeah.
Have you worked with those, and how does the?
Yeah, you can use your you can use your minimum tree structure again as a structure, and you will have a sequential node splitting that we can apply to. So absolutely, you can think of it that way. We just use dendrograms, but absolutely, you can use minimum spanning trees. Effectively, the math behind the structure of this tree and a minimum spanning tree would be very similar. In other words, you should be splitting into the same risk clusters more or less. It's just a different way of getting to a structure. But you're right. That's definitely something we can consider as well. Yeah. Yes.
Just if you the actual splitting, right, at the beginning.
Yeah.
How is it being split? Like for instance, like when you start at the beginning and it splits into two.
Yep.
So what's the rule for splitting?
Maximum distance of information. So think of it as a Euclidean distance between each. So in other words, it tests each object and then says what is the closest split. So you can actually do an Agnes or so in other words, you can do it from the bottom up or top down. Right? You can start at the top and say, how do I split my data into the most different sets?
So you're essentially saying there are two clusters, go to this one or go to this one.
Yeah. Okay. So statistically, you can start at the top and build a tree down or from the bottom up. We actually allow flexibility in going both ways.
And that's a distance sort of based.
Yes. Yeah.
And then initially in the presentation, you had different colors showing as you filtered down. Did those colors mean anything?
Yeah. So you can actually there's a package in R that you can color different, like optimally the highest tree intersection by color.
Okay.
Okay, because remember, the higher up, the more different it is. So you want to color, and I can tell it, give me 5 colors. So I just said, give me 5 colors. So in other words, it allocates the colors optimally between the most different sets. Okay, so it's just a way of visualizing it. It doesn't really have meaning other than just finding effectively the highest distinctions and then coloring them.
And okay.
There was actually stock, if you picked up, there was a stock that has its own color. That was Cecil.
And okay, that's fine. Let him go. The other question was like initially when you spoke about diversification, right? And then I honestly my mind was sort of moving towards factors, right? In this construction, right? I mean, if you had to contrast this then to say a factor portfolio,
Right.
Yeah. So can for instance, can you do something similar at a factor level? as opposed to just taking the stocks and then doing this sort of clustering thing.
Right. So in other words, by factor, you mean not a sort of a factor portfolio in the sense like a thematic portfolio, like a quality or value or momentum, but more in terms of what factors constitute risk parameters.
Correct. Yes.
So in other words, let's say build it saying, my 5 risk factors I don't want to consider is oil price sensitivity and this and this and this. You can actually impose that. We haven't done it. So let me answer it this way. What we want to do, what we set out to do, is to identify classes of risk statistically and then optimally diversify. We don't want to impose on our data the risk sources that need to be considered. You can do that in principle, but for us, it's less flexible. We want this to be as flexible. We don't want the modeler to decide what constitutes risk that you want to be diversified across. We want to say you want to be considering your data. How do you best diversify across sources of risk that's statistically defined? But you can absolutely expand this to include factor identification of risk.
Your similarity and your dissimilarity metrics, right? Okay, so it's based on a distance sort of thing. What about direction? Is it magnitude only, or
What about
direction?
directionality?
Similarity based on direction.
Yeah, it's Euclidean distance maximization, so it won't be directionality. Won't have an effect. Yeah.
Have you considered the direction based?
No. But again, something that can be, you can generalize it further. Absolutely. At the moment, it's Euclidean based, so I mean, it's just in dimensional vector space that you're maximizing and minimizing distance. Yeah.
Okay, yeah, completely different question.
Oh, good. Oh boy.
I like the way you mentioned that performance measurement of the portfolio, so it should be maybe a bit smarter. Okay, 2 things. First, how can I, instead of using 1/n or an index, how can I create an informed portfolio management? Just as an example, because I can't. A second question. Would you really argue that way, given that there's so many studies showing that most portfolio managers can't even beat the index consistently? I mean, they're all losing. It's such a small fraction that consistently beats the index. It's such a huge fraction that consistently loses against the index. So I would say, well, maybe they're not that important. Maybe they're not that good. So using the ETF or the index is. Wouldn't that be a fair way of doing it? So much better than all the spot methods anyway.
Great question. Do I have 2 minutes to answer the question? Okay, so great questions. Let me take both parts, right? So the second question is, I work at Satrix. We're the biggest index tracker in Africa. I mean, that's our game. We don't believe in alpha potential within asset classes, right? So sustainable alpha. You can after the fact say, well, we got this stock pick right, but my presumption would be over time, as markets become more efficient, your ability to find alpha will be netted off against your ability to not find that alpha. And the index is a very compelling investment case. The problem, and so I agree there, within asset class. Between asset classes is a completely different ballgame. In fact, our balance fund has been one of the most consistent, best performing balance funds because we focus all our attention on asset allocation. And therein, you can add a lot of value from a portfolio construction perspective. How you then proxy for those asset classes. If I say 20% must be in equities, how I build that, we use index building blocks, to your point, because you're not going to add alpha there. But the between allocation is actually an incredibly important step where there's no benchmark reference there. Right? That's a decision you need to make, and that's where this is the reason for why we utilize this framework when we build our SAA at Satrix. Then clearly the work we've done on this is we've put a lot of time in this, how we optimally allocate between different asset classes. And that's why Sanlam has taken our view on that. So that's a parent company on that. They take our SAA as like they don't do a more robust process, so they're like, we follow this, right? But then they try to tactically deviate, and we beat the tactical guys there because we just track the index. That's the first point. The second point is, how do we add knowledge to a random manager? The way we did that, and I had this bear bug every time I read. Like I said, I mean, just beating a random monkey is not an accomplishment. So why people use that in their papers? So the way we do it is, I say at each decision point, let's say quarterly, again, you can say, do our backtest quarterly, monthly, weekly, whatever frequency. But let's say we do it on a monthly basis. What I do is I say at point T, I let my fund manager look ahead 3 months, 6 months, whatever. It's again flexible. But let's say I look ahead 3 months, and then I can calculate what my return ranking would be for my universe. So I can see stock A or asset class A is at the top, Z at the bottom, and that's my ranking for the next 3 months. Then what I do is I randomly draw, or I randomly allocate weights to the different assets based on considering my restrictions. So I'll have sensible restrictions like 70% equity exposure, blah, blah, blah. But considering meeting my objectives, I then let the model randomly build a portfolio, and each time, so this is the I think a really interesting step. Each time it builds a random portfolio, it does a Spearman rank sum correlation between the portfolio, the portfolio weights that I allocate, my overweights and underweights. In other words, what's my ranking between overweighting and underweighting? That rank, I then do a Spearman rank correlation between the next 3 months. And then I ensure that that rank correlation is above a threshold, 30%, 40%. That I can actually set. So I can say, I dial it up or I dial it down. In other words, I make my managers smarter or I make them dumber. And so if that correlation is very high, that means I'm endowing the manager when they create their portfolio with the ability to look ahead and project what's going to be the ranking of future asset classes. And how similar my overweights and underweights are to that on a Spearman rank sum correlation basis gives me effectively knowledge about what's tomorrow's winners and losers going to be. I can dial that up and down. And there's still going to be noise, but I know there's going to be more signal to noise. So it's amazing. Using that, I can dial up the performance of my monkeys, dial it up, dial it down, like at will, just and now they perform better. And so then I have we've arrived at a 5% information coefficient. In other words, think of it as like going to the casino, putting money on black on a roulette table. It's not a 50-50 bet because there's 2 green colors. In other words, the house has an edge of 2% on you. So their information content is 2%. So we give our managers 5%. In other words, they're 5% better at random than predicting the next month's ranking. That in and of itself means they look random, but they're better than average. So they're good managers. And if your optimization algorithm can beat good managers, that's a higher hurdle to clear because you're taking away from the goodness of their prediction. In other words, they want to hold those stocks, but you're not telling them, have that information, but also consider this optimizer. And so if your optimizer pulls away their performance, that means you're making good managers worse. And the bizarre thing is, I hope it appeals to your intuition, like surely you should be doing that. No one does it. No one. I've never seen any paper actually do that. And to me, again, it's like as a practitioner, if you tell me this beats a random monkey, the hell's the point? If anyone can beat a random monkey, I would hope. And, sorry, does that answer your question? How we do that? Yeah.
Yeah. And I've just seen you have it in the paper. Yeah.
Yes.
Like, don't you? Yeah. I find it very interesting.
How do you prevent overfitting to the historical covariance structures?
So, sorry, say again.
Of your model to historical covariance structure.
Of the tree structure. Yeah. I mean, it's overfitting is not something you can ever completely discard. There is obviously the potential for overfitting at all times. But what you hope is that the difference between your node splits are sufficiently different to mean that you don't overfit. But here's the beauty. When you consider the tree structure, even if there's extreme overfitting to the point where you just consider the single node, you're anyway going to get back to your global optimization framework. In other words, if my global optimizer goal was mean variance, if I apply extreme fitting across my nodes, the worst case is I get back to mean variance. So in other words, the overfitting in the tree structure is far less of an issue than would be the case if we didn't have a global goal in mind. That makes sense.
Yeah.
Okay.
think you may have to open it to the web browser and then I get those problems with my universal traffic. So. Yeah. Work. You open it with Edge or, yeah, you open it with Edge and move that. Yeah, there's. No, oh, I did. You probably follow up the support, yeah.
Just open it.
No, it's saying that, yeah. So you need to just go with open, not with open. That's thing. And then there's an arrow up in the corner so you can go full screen. No, it's behind the black thing. So.
What the guy is gets in on the top, which is a lot about the benchmark.
Thank you. So this is my master's research, and it's a replication study on a paper by Blair et al. And essentially what we are doing is we are trying to extract and compare these new benchmark interest rates that are coming about in the world. So we're going through this global transition from these LIBOR benchmark rates to these new, what we call alternative reference rates. And essentially we want to see, is there actually a benefit in terms of noise in these new benchmark rates? So just the outline of my talk, I'll give a brief introduction and some background into the study. I'll go through the methodology that we've applied. I'll discuss and show some of the results, the replication results, as well as our new results in emerging markets, and then just some concluding remarks. Okay. So first of all, why are we going through this global transition away from these LIBOR benchmarks? I mean, why change something if it's been working? But yeah, what happened is that these LIBOR benchmarks were not working. They were prone to manipulation. This is because they are constructed in a way through panel-based surveys. So banks had these opportunities to distort the prices and of these benchmarks. So yeah, this led to manipulation scandals. And after the global financial crisis, there were stricter regulations imposed on these interbank lending in bank markets, and this declined the liquidity in the market, making less liquid and these quotes less representative. Okay. So just some characteristics, like I mentioned, of LIBOR. It's based on bank surveys rather than actual transactions. LIBOR was a forward looking term rate. So for instance, we'd have 1 month, 3 months, 6 months, etc. forward looking term rates, but it was vulnerable to estimation error and strategic misreporting. So this led to the development of these new alternative reference rates. I'll refer to them as ARRs from here on. And the aim of these reference rates was to improve transparency, robustness, and credibility. And in doing this, they made these reference rates based on observed overnight transactions, but they are now backward looking, whereas our previous LIBOR rates were forward. So these are just some of the major markets, their rates that they've changed to. So for instance, in the US, we previously had US dollar LIBOR, and they've moved to the secured overnight financing rate. In the UK, we previously had the GBP LIBOR, and they've moved to the sterling overnight index average. So what's interesting about these new reference rates is that each jurisdiction can construct the rates in their own way, obviously aligning with the principles of the IOSCO. For instance, SOFR is constructed based on collateralized repo transactions, whereas SONIA is constructed on unsecured interbank deposits. Okay. And we see different constructions as well in the other jurisdictions. Okay. So why are we focusing on benchmark interest rate noise? So firstly, just to give a bit of information on what is this interest rate noise in a benchmark. So this is typically random fluctuations in our benchmark, and these are deviations that do not reflect the true or genuine market conditions. And some of the consequences of noisy benchmarks would be our inaccurate pricing of financial contracts, unfair wealth transfers, reduced market efficiency, and increased volatility. So this leads us to the key question is that, are these new benchmarks that we are proposing and going to be using in the world, are they less noisy than the previous benchmarks, i.e. are they better? Like I said, I'm doing a replication study, and we first of all wanted to replicate this paper. And essentially, they tested the noisiness between the two benchmarks in developed markets. So in America, the UK, in the Europe area, Switzerland, and Japan. And what we did in our study is we applied this to some emerging economies where we see this interest rate reform. Specifically, we looked at South Africa, Thailand, and Indonesia. So how do we extract this noise from our benchmark? So this is sort of the background to our mathematical setup. So if we look at, we're only focusing on overnight rates. We aren't looking at longer tenors. So we see that in one singular day, both LIBOR and the alternative reference rate would be published, maybe at different time points. Normally, LIBOR is published earlier than the reference rate. And each time we see a reference rate, we see a noisy signal, but of the same underlying true overnight rate. Okay. So we're using this sequential framework, which was proposed by Grubler et al. To apply to benchmarks specifically. And this built on the sequential framework of pricing, of modeling prices sequentially over your jurisdictions. And yeah, so we're going to try and separate our efficient rate from our noise component, and we'll be doing this using a Kalman filter. So our efficient rate, the true underlying rate, isn't observable. We can only see the market rates, which contain noise, the noisy signal. So we'll have our state equation at the top, and we'll have our observation equation YT. And we can write it in this sequential structure. So when we observe LIBOR, we will only have the LIBOR entry and a missing data point in our data set. And when we observe our reference rate, we'll have a missing data point and then our reference rate. And what's nice about the Kalman filter, it accounts for these missing values quite well in its estimation. And we can extend this into, just for simplicity, into a vectorized form where we have our Z as our selection matrix. So for our LIBOR interest rate, we'll have a 1, 0, Z, or maybe vector is better. And when we observe our alternative reference rate, we'll have a 0, 1, Z. Okay. And then we can define our variance as a variance-covariance matrix of our noise. So our diagonal elements will be our noisy signals. Okay. We extend this model to include controls as well as observed variables such as central policy rates. Since our reference rates we don't want to attribute this noise to maybe central policy rates. That's why we include it in our model, so that only the true unobserved noise can be picked up in the model. Okay. So we model the policy rates with our XT, and mu is benchmark specific. This could be our credit or liquidity premium, and this is also estimated within our filter. Okay. So we apply the Kalman filter recursively, and we update. So the Kalman filter works with 2 steps. We first predict our next forecast, and then once we've observed our benchmark, we update our observation into our prediction, and then we predict forward. And we do this recursively. We then estimate using the maximum likelihood based on prediction error decomposition. Okay. We then, from our Kalman filter, are able to extract our noise. So sigma W is the true noise, which is from our state space equation, and the noise share sigma S would have our noisy signal from our observation equation. So we're mainly interested in our noise share metric, which is the proportion of the rate explained by the noise. And we want this noise share metric to be as low as possible for our benchmarks. And we want our information shares and our information to noise ratios to be as high as possible. So I'll first just go through some of our replication results. I'll focus on two mainly. So this is for the UK. We can see a large reduction in noise from our LIBOR, especially in this post-transition period. I'll explain more on that now. We see a reduction from noise of 88% to around about 12%. Okay. What happened at this transition date was the construction of SONIA included a volume-weighted trimming. So before this date, SONIA was based on, or it didn't have volume-weighted trimming on its calculations for the alternative reference rate. And after this date, they included, they trimmed outliers. So we see also a reduction in noise, maybe due to how these benchmarks are constructed. This is just an observation, it isn't necessarily a statement. However, when we look at the US market, we don't see a reduction in noise at all. We see 100% noise is attributed to alternative reference rate. Okay. And this is also could be due to how this alternative reference rate is constructed. It's based on collateralized repo transactions. So there is some noise maybe due to the supply and demand in that market. So we were also able to replicate the rest of the developed economies. Maybe just some key notes to key moments is that we see a reduction in the noise share in all of the markets. And we see an improvement in our information most of the time as well. Noise, that's also great, and more information in the benchmark is also a good sign. Like I said, we want to perform this on emerging economies. And these emerging economies are going through some, and not all emerging economies are going through these benchmark reforms. So we specifically just chose Indonesia, Thailand, and South Africa. These emerging economies don't have a currency-linked LIBOR, but in each jurisdiction, they have a similar, most of them have a similar panel-based, used to have a panel-based interbank offered rate, and they all went through these reforms to a more transaction-based rate. So in Indonesia, we went from the Jakarta interbank offered rate to Indonesia. In Thailand, we went from the Thai baht fixed interest rate to Thor, and in South Africa, we went from JIBAR to Zoronia. Just a note on JIBAR. JIBAR does not have an overnight rate. So we used SABOR, which is the overnight reference rate, which is also going to be replaced by Zoronia eventually. So why should these emerging economies go through interest rate reform if they aren't LIBOR linked? So the main idea was to align with the IO-SCO principles for robust and transparent benchmarks, and to also address the weaknesses that could be available in our interbank offer rate, also due to low liquidity and perhaps manipulation risk. So this is for the Indonesian market. We don't have a lot of data for this market, as the date where Indonesia was published and when JIBOR ended was quite, the overlapping dates weren't really great, or we didn't have a large data set, but we still got very significant results. We see a good reduction in noise share from about 80% to 20%. However, we do see a reduction in information as well at the same time. Looking at Thailand, we see a substantial decrease in the noise share, almost of 100%. So the noise attributed to the Thai, to TH prefix, was almost 100% versus to Thor, the new alternative reference rate almost has 0% noise. However, the information also doesn't increase substantially. Looking at the South African market, we again see a decrease in noise, but a very marginal, not even an increase, we see a decrease in information. Okay. So the overall pattern in our emerging markets is that we see that these ARRs are consistently leading to lower noise shares. However, we see a reduction in informational content. So even though these benchmarks are less noisy, the information that these benchmarks are contributing may not reflect the true underlying market conditions. So some of the implications is that our benchmark quality is not merely shaped by the methodology, but also by the structure of how these benchmarks are designed, and also on the markets that they're based. So just to conclude, we were able to successfully replicate our target paper, and we were able to extend the framework to emerging markets. Overall, we see that reference rates are less noisy, but that benchmark reforms need to remain context specific. Okay. Thank you.
Question, Catherine? Any question? No?
Well, first of all, it's a very nice replication study, right? So it's used the results, but also standard on it by including the emerging markets. So it's definitely a nice contribution to the whole discussion. So what I'm actually going to say now is not really a criticism of your work, it's criticism of the original paper. And there are big problems with that paper, right? Of course, it's not in the scope of a replication study to address those, but they're basically comparing apples and oranges, because just in the beginning, when you were introducing the how the study is set up and how these rates are actually interpreted in the counter filter methodology, they're basically treated the same way, and they're totally not, right? Yeah. And it's fairly obvious that just from the structure, for the fact that LIBOR is forward-looking and SOFR is just a silver compound, even backward-looking. Yeah. That you would expect these new benchmarks to have less noise than the old benchmark, but it's just so fairly obvious, and I guess it's more or less an indictment of JFE that they published this sounds quite often.
Yeah. No, it was something I questioned a lot, and I still question today. That's something I'm still wrapping my head around.
Yeah, so it might be nice to do a follow-up study, right? Yes. To actually rigging that criticism, right? Certainly the results are replicable if you make the same assumptions. The assumptions where the problems are.
Any other question?
No, fully agree with you there. We've had this discussion internally as well. That is the problem. It's not the same thing. It's hard to get around that. I agree with you. The forward-looking nature of the one and the pricing of the other. But in truth, it's one of those things. I mean, how far do you want to look forward with those rates? What's a sensible? is that forward-looking setting of your estimation in JIBAR, that you get that, but with that you get the potential for gaming, like we've seen in LIBOR rates, right? Where guys are adjusting their survey based on like an outcome, and then they can manipulate. So that manipulation is a clear concern for JIBAR or for LIBOR, and solving that needs to be done, right? So it's not a perfect measure. I agree the studies are not comparing apples with apples, but kind of in our mind, the fact that you are moving to something that is being priced in the market as opposed to what is a derived concept that I can influence, I think is a step in the right direction. We kind of like it from that perspective. But I agree, the studies are all odd, man. It's like, how do you solve that?
Well, look, I mean, these in other jurisdictions, right? You do have these term rate benchmarks, which are based at least in part on transactions. So Australia has BBSW, which is partially, at least partially transaction based, and also Euribor is still around. And hopefully those jurisdictions are not going to get rid of them, because what you really want, if you're going to benchmark, if you're going to reference these benchmarks, for example, for loans and things, as a bank, you want them to relate to your funding cost. And SOFR compounded, for example, as a term rate, it's not a term rate. It doesn't have anything to do with the bank funding costs.
Correct.
Question or comment? No, that's fine. We will break now. We can go to the NITheCS, grab coffee or something. Yeah.
Something is made with the student performance.
Get some pictures.
Masters. Student of mine was based on something the Hudson guys had done. That and what we wanted to publish. Like it was lacking some meat there. Have a look. I thought, oh, so you have machines.
Yeah.
Money. Really money.
Haven't you got the vouchers?
So much work. Wonder about that verification. With that. And remember this study, I was like begging our investment colleagues to have a look. That's because he had a bit of mind. Because I was asking them, how do you actually do the
Thanks for the
Okay.
So I will be back later.
Yeah, going to grab some coffee. Is that getting some coffee?
Very interesting stuff. I'll try to through the paper. Even citing our study and the diversification now.
Oh,
So
yeah.
I don't know whether you're using that at all in or
Yeah, yeah.
Oh, yeah, okay.
So that was the DD on those graphs. We actually,
Okay, so you were
yeah, we used. There's a weird one. Yeah, yeah.
It's very strangely.
We actually,
So did you use the original one by Morgan, or did you use the one like the paper Salazar, because they got it wrong in their paper, they're not doing it right.
the original paper.
Yes.
Oh,
You should check, because we're showing why it's wrong the way they're
okay.
doing it.
We-
But in the end, it doesn't make such a big difference, right?
yeah, so we will use 5 measures of
Yes.
diversification, of which DD is one.
Yes.
But then,
Check the DD one, I think we call it DD star or something, and that is correct. What they're proposing is not correct.
I think.
Yeah, or maybe you use the one, it's just citing that it's
Yeah,
Salazar and all, it's also in the portfolio.
It's been a while, but
Yeah, of
yeah,
course,
it's,
it's also been a while, I can't even remember what the formula was for that. But
that is an awkward, it's a measure, and also, like here is.
Seems to be so many techniques, right? And that question,
That's weird number, yeah.
what do you actually?
Kind of said the same thing. He said because
That you
how
actually
you, diversification is such a nuanced thing as well, how you measure it. And so we said, well, irrespective of how you measure it, it improves, because that's probably
gonna be around
the metric. Because then I have to defend why this one. I don't want to say, well, here's all of us.
stretch my legs a bit. We're standing.
Yeah, I'm gonna,
Okay. But what actually say is four there.
And which is, of course, uh, yeah, since it's a language which doesn't use our alphabet.
Yeah,
Um,
I had Japan is very developed, like,
oh, yes,
yeah.
in some ways it is.
Mhm.
But then in some surprising ways, it's not. So they have a lot of things where you still have to pay cash.
Really?
Yeah.
Yeah.
And luckily I was forewarned because I did have a look at some of the web
Okay.
sites, you know, like travel advice for Japan. It's good that I did that because otherwise I would have been stuck and I would have just assumed that,
Yeah.
you know, you can use cards everywhere. No.
Yeah.
I think I'll have it go with it.
Yeah. So we also listed as a longer afternoon waiting for the land, the lady was at the big lab, also is also not around.
Okay, so,
I mean,
so we'll finish early.
yeah, after lunch, we finish 1 o'clock also,
Okay.
and then, yeah.
Great session. I'm super keen on reading both papers.
Yeah, well, especially the first one.
Yeah.
Yeah, but that's only because I've already read the second one.
Yeah, I guess so, because Charlie. Yeah, I mean, it doesn't, I think what you said makes perfect sense. They're really comparing. It's absolutely zero surprise that in the market data, it's backward looking, you have less noise.
The top 10 journal they just published the.
Oh, I mean, they're big names.
Yeah.
And recently.
Yeah, well, but that's the. I mean, you get that every once in a while, I mean.
JFE is particularly
Yeah, and
weird in that sense.
for example, Francis Longstaff is a repeat offender in that respect.
Yeah, okay, I'm probably not good enough to judge that he has done, because I thought he's great, but so there's also some bad stuff by him in there, or?
Well, you know, then, and actually, I mean, the fact that he's so well known, right? Longstaff Schwartz wasn't really his original work, right? That algorithm was well known, it just wasn't well known in finance.
Yeah, that's all.
No, and then there was a paper called, that Longstaff was involved in, which was, and I think it was actually another Longstaff and Schwartz. Paper, and it was called Throwing Away $1 Billion to JFE. Have you ever seen that one?
No, I haven't.
And
It sounds interesting.
well, basically it was about that the banks that were using only a one-factor model
Okay, yeah.
to price swaptions were throwing away $1 billion. And luckily with that one, the total rebuttal of that paper was published in the same issue by Anderson. Oh yeah, Anderson and Andreas.
But they still published it?
The thing is, they still published that. If actually these other guys had been doing that, they hadn't managed to get it into the same issue, they people refused to publish the related paper. Yeah. Right, because and that's also a big problem with these big journals.
Yeah, I think they should be far more open to to make Q&As. I mean, the process. Have 2 reviewers. They can also be wrong. There's no guarantee that what is published in the top journal is right, and I think we should approach it. And they should be more open if someone shows clearly. Because I've heard that so many times. You write a comment or something, and I mean, I had that too. Something that was clearly so wrong, and then they said, "Yeah, might be wrong. Most guys did it the same way, and maybe what you could do." It's just like, well, but I was just writing a short note to point out that what they're doing is wrong. And then the editor even agreed it's wrong, but we're still not going to publish it.
The first one has to, it's the gospel.
Imagine if Donald Trump was publishing.
Well, then everybody else only writes fake.
He will be like, did you just refuse to publish my paper?
We'll see, he might just take all and push his way into
He will
close
close the Department of Education.
Yeah, well, all these climate science journals will get cancelled.
Yeah.
But talking about, wasn't yesterday that people said, oh, now lots of people from the US will come. We were advertising the position because we got like some of this Lancet countdown on climate change and health of the ocean team. And we had to do positions. And it was really interesting because there were lots of applications from the US. So we did a ranking. Top 3 were all US journals. Stanford. None of them came. So I don't know whether because I mean it's a big step to do. They all said, "Oh, we don't know whether we'll have to job and so blah blah blah." So so in the end, we went with Australia.
Yeah, because there's a risk also, right? That some of them come and then there's a regime change, they all want to go back. Right? And then you
That
have
was also what we discussed.
Yeah,
But we
even
even
the position.
because for them, we're probably just like a backup.
Yeah, I mean,
The things will probably change.
Okay, welcome back. And I'm going to take you through some of my studies that I'm doing on wine as an alternative asset class. And so in this study, we're going to do a comparative analysis on country-based index, especially the more emerging markets. So we have taken South Africa, Australia, Chile, and also Argentina. And what we did, we compared this to NITheCS 100, which is the a world benchmark index for the wine. And I'm going to explain through as we go along. Okay. So, and again, how do I do it? Okay, well, this is a joint work with Robert Pfaff, who is a professor at the Convenience University of Budapest, and Lauren Kins, who is a wine expert at Wine Cellar and Strauss & Co. in Cape Town. And this is actually the only auction house here in South Africa. And he actually the one who provided us with data and also some market insight about the behavior of the South African wines. And also Vedic, who is at the University of Auckland. And he provided, I mean, he also did quite a lot of research on wine. And he provided us with data for Australia, Argentina, and also Chile. And so So those are people that I have to acknowledge. And what actually we want to consider, okay, if you look at the alternative investment, and so you want to invest in assets which are not really so popular. But now alternative investment, now you look at who really consider to do alternative investment. And these are probably the wine producers, or like you have a capital investment in wine expansion, or maybe sort of cellar infrastructure, or maybe branding. And also collectors, or maybe wine enthusiasm. So maybe look at those net wealthy individuals who just want to invest their money into something more stable, or maybe consumption utility and so on. And also institutional investors and those who are looking for alternative investment for, say, portfolio diversification and so on. And so also wine exchange platform, like maybe wine club and so on, and also say wine fund. And in this case, I'm also going to talk to you about a wine investment vehicle that we created with Strauss & Co. and to provide a wine exchange platform where people can actually invest into this wine investment vehicle. So the idea starts from what is globalization? And globalization is actually the market integration into the world scale. And what does it mean by market integration? It means that market operates according to the law of one price. And what does the law of one price mean? That means identical goods must be priced at the same price. And well, that's even more complicated because, I mean, if you sell a bottle of wine here at 120, and so if you take it to Namibia, you can't sell that at 120 because of the transportation and all other transactional costs. So, but the law of one price means that even if you are going to price at a certain price in Namibia, the price should not exceed those transaction and transportation costs that has been involved. So, and again, so the law of one price, that means there are transportation and other transaction costs involved in bringing goods from one market, say London to New York. Therefore, the law of one price must be rephrased. So the law of one price means the absolute difference between identical goods sold into two markets must not exceed, let's say, the transactional cost, or say the cost of, say, transportation cost. So the globalization is not new. So the cultivation of wine began about 6,000 BC or before Christ, and spread from Middle East about 250 or 2500 before Christ, and spread from North to Mediterranean by 400 AD or Anno Domini, and also took about 100 or 1100 without no activity of wine at least, and then spread to South America by 1500, South Africa by 1655 years in that year, and also then spread to Australia by 1788. And actually this spread from us to Australia is actually from Rio and also from Cape Town. And also California and New Zealand by 1820. So that's how the wine actually spread out through this globalization. Why is this relevant to South Africa? In particular, if you consider South Africa is ranked the 8th largest producer of wine in the world, and also it is actually standing at number 6 in terms of exportation. And also there's an increased competition. Those are called the new world for producers, especially if you look at Australia, Argentina, and also Chile, have expanded by bottling like premium bottles of wine. And also there's a market diversification. So there's a wider range of exportation for South African wines into different markets. And so there's a lot happening in terms of wine industry in South Africa. So which warrant us to do some research on South African wine and compared to other emerging economy. And this is what we were doing this research. Again, like I said, there's from the global community, there's a lot of demand from the South African wine, especially the premium South African wines. And also there's an improved export performance. If you look at, and this is comment from actually the expert in wine industry. They said there's actually a higher demand for the real premium South African wine from the international community. And also in South Africa, even if you see Stellenbosch, for instance, there is established infrastructure and viticultural heritage for about 300 years of winemaking tradition in South Africa. So I mean, South Africa is well regarded from the international point of view when it comes to winemaking. And the Stellenbosch University, for instance, is the only university with a department of oenology and viticulture, meaning wine and winemaking. So they also invest into the infrastructure. There is a competitive cost based on, say, climate change. Again, the South African, I mean, most of the wines here, if the wine farms, say Longridge, for instance, they do these organic wines, which means is to prevent, I mean, organic wines will not be subjected to climate change. And then there's also last month we went to Lanzarek, and then we met the winemaker there, and also say they put some strategies to mitigate against the climate change. And also there's a comparative advantage over traditional producers for forcing oversupplies and climate change. So there's quite a lot in place so far against these climate change in terms of wine production in South Africa. And again, there's innovation, the sustainability, which is embedded into new generation of production of wines. And if you look at South Africa, the wine industry is actually contributing much to the tourism in South Africa. Most people come to Cape Town or Western Cape in general because they want to do wine touring and wine tasting. So if you look at some of the key risks, and then of course there's strategies to minimize these risks, like load shedding, for instance, is one of the risks. Policy consideration when the government is, or when the policy or lawmakers are introducing new rules against alcohols and so on. All this, there is actually a proactive strategies to make sure they mitigate all this risk. And so our thesis, our main selling point is to make sure that investment in South African wine should be taken seriously, because there is value in investing in South African wine. Many global international investors, they said South African wine is good for drinking, but our thesis is that it's not only good for drinking, but it's also good for investment. And this is which we're trying to do here. So I want to give the overview of the South African wine industry again. About 950 million liters are produced every year for wines. And about only 52% of this is consumed domestically. You are making a point that some wine are made here before before they even reach Cape Town. They are already people drink the wine already. So only 52% is consumed, but about 48% of the production is exported globally. And the compound annual growth is about 6.2 for that, which is really good. And the export markets are UK, Germany, Netherlands, US, and China. And there's also most of the wines that are made here: Chenin, Blanc, Pinotage, and Shiraz. And there's also a rise in international ratings. These are the wine critics who do rating for the wines every year. In South Africa, we actually have Tim Atkin, who give rating to the South African, but there's also international raters like Plata and Tikenda, who also put much effort to rate the South African wine. And again, I'm going to highlight to this that this value of this importance of this critics rating, because when they give a rating, it actually shifts up the price for that wine. And also, there's so much alignment with ESG goals through regeneration of viticulture. So I mean, these are important laws that are put in order to make sure that it conforms to the laws of this ESG. Yeah, and of course, if you compare between the three countries, Chile and Australia and South Africa, but of course, you see that Australia is more developed market. About, say, the GDP is 1.7 trillion, while in South Africa it's about 400 billion rand, dollar, in US dollar. And the export, like I said, about 48% of the wines that are made here are being exported globally, while in Australia, there's an export of about 65%, which is great. And the currency, of course, here this one is stable. And of course, Australia is very strong because that's more like leading in terms of development. And South Africa, the rand is actually depreciating. And there is importance to that when it comes to wine, because the value for wine is going up when the rand is depreciating. And the domestic consumption Chile is actually very low. In Australia, it's moderate. But in South Africa, the consumption is it's actually very high. Yeah, of course, there's a lot of tourism. Again, this one is emerging. In Australia, it's actually mature. And South Africa is leading in terms of all the emerging economy. It is actually a lot of tourism activity due to wine testing. And again, the policies that support the production of wines in Australia is very strong, while in South Africa there's actually an improvement. Okay, wait. And also, if you look at also the value chain, and so the climate here in South Africa, so if you look at in Stellenbosch and Swartland, for instance, those are the main area where the wines is made here in South Africa. I mean, it's actually it's okay. It's South Africa. I mean, Stellenbosch is well positioned with climate change, and so but of course, there's sometimes drought and power outage, which means load shedding, and that's also. And then, like I said, the main wines that are made here are like Chenin, Blanc, Pinotage, and so on. And here, there's about 555 or 56 actually of these wine cellars in South Africa, which is also good. And is also actually labeled as a new world when it comes to wine making. So with that motivation that actually there's actually a lot, this value chain in South African fine wine, and there is a lot of activity happening when it comes to South African wine, we came up with an idea. Actually, what happened is I look at this NITheCS 100. NITheCS 100 is actually the London benchmark, that's a world benchmark wine index that actually track the performance of the top 100 wines in the world. Then I was curious to see what are the constituents for this NITheCS 100. There's only one Australian wine, which is the Grudge Penfold, and there's 3 US wines, but there's none from South Africa. Then, but I mean, if you look even from the international news, you see that South African wine, people talk so much about South African wine, but there's no even a single South African wine in this NITheCS 100. Then we thought of like, how about we create an index for the South African wine that can actually track the performance of the top 10 South African wines. And then this index we have created up with the help from Strauss and Co, who gave us data to be able to construct this index. And this index, so we got a lot of wines data. So we filtered in such a way, we look for 3 criteria that makes in top 10. The liquidity, how often is this wine sold? And then we also look at in South Africa, like I said, there's a wine advocate who gives the rating to the wines. Then this is called the Tim Atkin. We take the 5-year average, and then we take an average of that. And then we also look at the value of the wines. So like I see there is one wine from Canon Corp. It's called the Black Label. And this wine is actually too expensive. It was like one bottle of red wine is about 48,000. And so this actually it was given proper rating, but it's just bringing sort of like outliers in there. So we took it out of the top 10. So with this study, so we develop up this study, and this is appearing in our paper that we published actually now in the journal Theoretical and Applied Finance. And in that, we create up an index that reflects the top investable fine wines. Like I said, there are 3 criteria that we look at: the liquidity, the quality, and also desirability criteria, which are measured by the wine critics who gives them. Then we prove that there's a historical return of about 12 to 14%. And also we show that it outperformed, the index outperformed the traditional equity during volatile period. And then we also show that it's negatively correlated to the stock market. So that you can able to use it as a hedge against your when there's financial crisis, the wine even when there was even when you look at when there was pandemic, the wine market in South Africa was just going up because the wine was still a variable even during tough period. And this wines index is being updated every 3 months by the wine seller or Strauss and Co. And we actually in the process of actually being able to trade this at Johannesburg Stock Exchange. We introduced 2 years back, we introduced what we call the active managed certificate, and then we call it bond wine. And this is a wine investment vehicle that we invite investors to invest in that AMC. And this AMC is actually managed or administered by the share capital. And this is a portfolio of about £50,000, and all the wines are currently stored in London. And I'm going to give a little bit about information about this. And my role here, I'm acting as an advisory board for this AMC, and is managed again heavily by the wine seller and myself. We're very much involved into this certificate. Of course, the index. So the index, we show that there is actually a diversification benefit. And like I said, it's negatively correlated to many of the equity, stock market, and so on. That means one can use it as a hedge. But in that paper, we use some stochastic benchmark models or stochastic models to show that if you include this wine index in the portfolio that consists of top performing assets or index, your growth rate actually increase and your portfolio volatility decrease. And then, but this is not new. This has been a well-known study that if you include wine is actually negatively correlated to other assets, that means you can able to reduce your risk of the portfolio for investment if you like them. So again, these are some of the index increased diversifications. It reduced the portfolio volatility. And then in this case, we use actually this is a basic studies of creating an index using repeat sale regression. So one wine that's sold now, and then it's sold another, so that's repeat sale. And this study is actually a concept from real estate market, and that was invented in 1960s. And then we use these concepts to construct the index. But now we actually improve the methodology from just using repeat sale to using hedonic in order to create up all other index that we are studying in this paper. And like I said again, this wine is uncorrelated with equity and also outperform bonds and often stock. So that means it's a valuable. It's something that we're happy with, is that this index can actually be valuable to us if you want to diversify your portfolio. Okay, so again now, since that, this wine seller actually is managing about a portfolio of 80 million rand. And also now, since the wine index, there's actually about 90 million rand added to the secondary market, because people are now, even the South African international investors, are more interested in these wines for South Africa. So yeah, so after we developed the wine index, this was a growing interest from investors in South African wine. And this actually, since the inception or the onset of this index, this paper attracted many media attractions. They wanted to know about this index and the value it creates in the South African wine industry. And again, so far there's no mathematics, but because I'm a mathematician, so we'll have some maths later. Okay, so again, I'd like to acknowledge Strauss & Co. This is the auction house. Actually, it's actually the one in the secondary market, and also it sell about icon vintage wines. And The top performing of these wines are the Canon Cop Paul Sour. Canon Cop wine farm is just along R44 going to Clubmart, and actually has a compound annual growth rate of 30%. And the Paul Sour probably, the bottle is probably 1,200, but actually that you can use it as an investment. You can buy it now, but in say 2-3 years, or so let's say 5,000. And okay, in this South African wine, return can actually be in some magnitude can be compared to Bordeaux and the NITheCS global peers. So that means there is actually value in this wine index. Again, I would say the bond wine, the wine investment vehicle that we currently running or established, is actually tradable, and net value linked fine wine portfolio, and which is backed by this bank. And I was happy when we started negotiating with the Strauss & Co about this. Now, so this one is a South African fine wine 10, and this is the Argentina wine, fine wine, and this is Australia chill, and these are some of the EFT for the stock, and also you have the EFT for gold bond, and these are properties. This is the NITheCS 100. You constructed the portfolio, and then you do the normal portfolio optimizations, and then you calculate your annual return, your portfolio volatility, and also the Sharpe ratio. But you can see the South African is very wine is very volatile, but you have the annual return is pretty good. And also the Sharpe ratio is not too good. I mean, if you compare the Sharpe ratio of the NITheCS 100, but I mean, if we construct up this portfolio, you see that I think there is a lot of risk diversification in this. Then of course you see also Argentina wine, there's a negative annual return there. And this index is created using Handoni method that's combined with repeat cell regression. And this methodology, we call it a hybrid method of creating up the index. And then now, if you create up the index, you rebase everything at 100. And then you see, like if you see the South African wine, it's very volatile. And if you see the NITheCS 100, it's not volatile at all. And because I mean, that's a well-established fine wine index. But again, you see the Argentina and Australia is also not volatile at all for that period. And then also when you see here, we also have the properties. They have a negative Sharpe ratios, and then also the Argentine wine also have a negative Sharpe ratio. But you see the South Africa is not too bad. So the one with chilled fine wine and also the EFT S&P 500 have the highest return and lowest volatility is the NITheCS 100 and also EFT S&P 500. And the S&P 500 also has a strong Sharpe ratio, and South African fine wine has one of the highest return, but of course the volatility is pretty higher. And meaning the equity ETF shows a strong risk-adjusted performance. This is wine index, and also this shows that the wine indices that we have in our portfolios provide a diversification benefit with a low correlations to the equity. Why I didn't want to talk about this benchmark approach now, but I think I'll run through. So in our study that we create up the index, we used a lot of concepts from the benchmark approach. And this is the approach that was developed by Professor Eckhard Platten in 2006. And the framework is that you choose a numeric portfolio, and this is called the Growth Optimal Portfolio, the GOP. And then you judge a portfolio in a GOP unit via the benchmark wealth. And then the benchmark wealth is given as D over G. And under benchmark approach, the self-financing strategy should not show a persistence drift in a GOP unit. And so now what that means, you're working under a real world, so rather than a risk neutral world. And for that, and then the GOP is the portfolio that maximizes the expected log wealth over a long time horizon. And equivalent, you can also write it like that. So you want to maximize that. And then now, but this is the one now that serves as a numeric portfolio. And again, so you have a benchmark wealth. Then you take from here, you can take the log, and then you take the increment. You can write it like that. And then what you want to maximize the expectation of this benchmark approach. And then what you want to do is we want to analyze what is the, say, the standard deviation and so on for the log of this benchmark wealth. Okay? And if you have, so you create up a portfolio, and then you say this portfolio is a diversifiable portfolio. That means can be approximated as a GOP portfolio. And now, so in wine terms, so you can use the hierarchical diversification by, say, using particular vintage or particular cultivar, for instance, or region and so on to create up this index. Okay, well, like I said, now we want to define some metrics, such as, say, the tracking rate. And the tracking rate, because now we have monthly data for the wine index. So we calculate the tracking rate by actually saying this is the square root of 12 times the standard deviation of the change of the log of the benchmark wealth. And again, so we create up 3 portfolios. This one is the equal weighted index portfolio. And then we have this, the DWI. The weights are actually proportional to some constant C, which means these are the size that raised to the power P. And then P is in any element from 0 to 1. And then we have now this one we call the hierarchical weighted index. The hierarchical equal weighted, meaning it's equal weighted across group, meaning across, say, vintages, and then across, say, some wine farm or cultivar or region and so on. And then this is the one that we're going to use this as a GOP for all. And then this is how you calculate this, the diversity weighted index. So that means you compute CI, which means it's like the price, and the weight is computed like that. And then if P is equal to 0, then you boil down back to the equal weighted. And if P is equal to 1, then of course you have some characteristic weight. And then this is how you actually compute the DWI portfolio. And hierarchical weighted index, this is calculated. So you first take a group, from 1 up to G, say vintages or maybe region or say country, and then you compute the weight within across group, then also within each group, and then you compute the index. Okay, of course, because when you have a portfolio, you can either do rebalancing every month, and then you can also calculate the turnover, which is computed in this way. And then you can also factor in cost of transactional cost, or maybe say insurances, you also have to make sure that you capture that. And then after that, we also calculate the net asset value of each of these. Okay, well, here we also calculate some metrics like down and also net asset value. And then we do the benchmark. Because now we compute the net asset values, then we test the portfolio using the gross optimal proxy, which is G. And this is what we have here. We calculate the change in the log, and then we report the mean of the log, the statistics, or the t-steps, and the tracking rate, also the fraction of the math change. Then what we want, and we want to make sure that this is negative. Okay, so we compute those metrics, and then also we look at the concentration, and then this is a Difford-Hirschman index, which is to judge the portfolio levels of concentration. And then we actually going to compute this metric, the HHI, in our portfolio. Okay, so now because then we have different portfolios, then we compute the mean annual mean return. Then in this case, we are using the log return. Of course, you see that this one is outperforming in terms of it has a higher return, and then the volatility is also higher in that case. And so this is just a portfolio of wines, or of wine index that meaning it consists of Australian wines, and also Argentine, Chile, and South African. We also added NITheCS 100 into this portfolio. But of course, here, the one with this one is actually much, because you want to make sure that this HHI is very low. And which can I? But we are using this one as our gross optimal portfolio. And then if you look at the tracking rate of we want to make sure that this is what we're using, because this is the one that we consider as a GOP, and the tracking rate is equal to 0. But all other portfolios have varying level of tracking rate. Then again, we look at we compute the mean of the wealth, meaning the change of the log of V over G, and then we see the mean here for some of the portfolios is negative, and this is one that we're using as a global or GOP. We expect it to be equal to 0, and the fractional decrease is equal to 1 in that case. And then again, you see the behavior. Like I said, the W or DWI P0 is of course the one outperforming, but the benchmark one is definitely the second one, which is that one is also good. Okay, you rebase it. So that's a benchmark approach that we have for computing to check actually the performance of the wine portfolios. Then we look at what we call the dynamic correlations model. First, we compare the two, which one is called the dynamic correlation model, and the other one is the asymmetry dynamic correlation model. because the thing is, if you only compute the static correlation, it's not enough because the correlation changes over time. And so the asset return correlation are time varying, especially during market stress. And so that means using a static correlation assumption can misestimate the portfolio risk. So there's need for models that adapt evolving market condition. And that's why we want to study this dynamic correlation in this. So this is the basic model, the gauge model. And then, so this model, of course, capture the market's volatility cluster and persistence. And then we estimate a series of residual, which means epsilon over square root of H, and then the H is the return prediction. Then with the dynamic, so this is now the dynamic correlation model. So now what you want to estimate, you estimate the gauge model each, and then you get this residual, and then now you use those residual to calculate the correlation dynamic via Q, which is computed in that form. And those parameters like alpha and beta has been already estimated from the gauge model. And then the application is we use now this time varying correlation between, say, our index, our South African wine index, and the LITheCS 100. And we're actually using LITheCS 100 as the LITheCS 100 as the benchmark index in this case. Then, of course, we compute the correlation metric, we compute it in that form, and then we measure the dynamic parameter, which is alpha. And so alpha actually measures the sensitivity of the recent shock, while beta measures the persistence in the correlation process. And then we also make sure that the sum of these two parameters are less than 1. And then we went to asymmetric. So that means this model actually accounts for leverage effect, because then you have because the correlation responds asymmetric to positive or negative information or shock. Then we recompute our Q like that, and in this form, and again we implement this to our model. And then these are the estimation procedures. First, you fit your normal univariate gauge model, and then you compute the standard residual. From that, then you estimate either the dynamic or asymmetric dynamic parameters via maximal likelihood. And then actually here we are using MATLAB. In MATLAB, we use the toolbox, which is Master in Financial Engineering toolbox, to compute. And then there's a lot of packages from financial econometric in that. Then, of course, here we want to portfolio optimization with time varying for various parameters. Then we can also compute the variance risk estimation, or maybe stress testing correlation during market stress. And then we also compare these models. Then, of course, because you see the behavior, because you have LITheCS 100 as a benchmark, then we're testing against all those. Then, of course, you see the one with the low correlation with meaning like profit, for instance, and you can use it for hedging the wine index, the LITheCS 100. And then, of course, you see the correlation between our wine index with LITheCS 100 is also not bad. And this is when you compare between these two models. Then again, if you see the correlation, so this one is actually the lowest one. Then, of course, you see if you see South African, Argentine, Australia, and also Chile, you can see that they are low correlated to all other many assets. So that means there is actually a diversification benefit in this case. But if you see, so like if you see South Africa with one large X100 is color, so that means, of course, there's a low correlation. And then this is also low, but not too much, because what it is in this range, also not too bad. And then here, of course, here it should be 1. That's why it's South Africa was right. And then also with Argentina, and with South African fine wine, it's also very low correlation. So that means one can hedge against other wines. We went on to do also factor analysis. So we did a principal component analysis, and we grouped into 4 different factors. And the first factor is the one that explained about 27%. And we group into these factors. And then after we group the constituent of our portfolio into 4 factors, and what we want to do is, so we have now global developed market equity. So those are like the S&P 500, and also this index. And then again, we also established a new class, which is called the South Africa real estate asset. And the real estate asset consists of the properties and the bonds, and as well as the gold. Then we have the market or emerging market equity. And then also we have another factor which we call the fine wine premium. And this includes the South African wine index, the Argentina, and also NITheCS 100. And then we do the factor analysis. So I'm not going to go through that. And again, here, and the implication of that is that the global equity, which is F1, and the South Africa real estate capture the mainstream market moves, while the fine wine factor is truly orthogonal. That means offer low correlations, and that means it offers a diversification benefit. Because I mean, we want to really make sure that we test that this wine index can actually be used as a diversification asset or a diversifiable asset. So that means, or it's a strategy for diversification. That meaning wine index, this actually is better for Australian and South African wine, are actually better for investment. And then you can hedge the broader market exposure via using, say, the short position in EFT, S&P 500, as well as the other index for STXW. And here are some of the risk analysis and also mitigation strategies. So we have volatile, because if you look at the rand, well, it's volatile. So now what I mean, you say FX hedging and US-based contract, energy in this case, because of load shedding here in South Africa, meaning you say off-grid solar investment and battery storage. And this is what actually happening now. If you look in Stellenbosch, all the houses are made with either solar. There's actually something like a backup to mitigate this policy. Like in South Africa, there's a lot of like now changing tax and also import regulation. So now here engage through, say, Wine of South Africa, in order to provide advocates for this wine index. And reputation, so, or maybe say, cost labor, there's a cost and productivity concern, meaning here we need to educate the workforce or upskill the workforce or incentivize the the productivity. So those are the risk mitigation strategy. So now, how do you encourage or persuade investors to invest in these fine wines for South Africa? Of course, these are some of the studies that by Carl, say for instance, it all points toward that a wine advocate, those who give ratings to the wine, actually pushes the prices up. And this study also showed that the Haridai is the wine critic in Australia, right? It's the one that gives rate.
It's basically filling in the gap because Parker no longer does Australia.
Yeah, okay, yeah. So Australia and New Zealand wine. So that means the higher the score, the higher the purchase price, but also, yeah. So how to decide which wine to buy and which wine to drink? So pick the wines with a strong secondary market liquidity. So because then that one you can use to resale, to sell it again. For consumption, consider less known wine. Like you can't drink up your Canon Cup wine because Canon Cup is well known for investment, and of course account for climate change. And this is some of the wine farm now has resolved to make wines that are more organic, that are more resistant to the climate change. And the implication to stakeholders, the stakeholders are like the viticulturalists, who are the ones that are making wines, leverage climate change data to site selection and price negotiations, and also the winemakers to adjust grape purchase and also for the list price of the wine. And I think that will be the end of my talk. But here, I just want to, again, because we established up the wine investment vehicle, which is called the bond wine. And again, we are planning of trading this index on JSE. So I would just summarize by saying South African wine industry is globally relevant, globally recognized, but sometimes it's seriously undervalued. There is, of course, advantage of investing in this South African wines because it has a long-term higher growth rate, and there's the return is pretty good. And if you are a long-term investor, so I think it's much better to invest in some of your money into this index. Again, I would say investment in South African wine should be seriously explored. Thank you. Yeah, I'm happy for questions. Yeah, Eric?
Yeah, it's very innovative work this year. So that's why I really like it. I really like this topic. And as a result of being so innovative, I think it opens up, right? There's a whole lot more work to do, right?
Yeah.
And I mean, one thing that I noticed when we were talking in particular around the GOP is that maybe one needs to recast that question a bit.
Okay.
Right? Because using the GOP as benchmark,
yeah,
right? Is valid if you take a growth optimal portfolio as a whole, right, for the whole market.
Yep.
by defining this growth portfolio just based on the wine
Yeah.
market only.
Yeah.
You're shrinking the universe, right, to become wine only. Seems like a great universe to me, but that's not what it is, right?
Yeah, yeah.
So, and it's perhaps an avenue to pursue there instead would be to look at the impact of including the various wine indices, which are clearly not the same, right? They've shown that they're very different in terms of their behavior in a portfolio. So the papers, theoretical papers on what happens to the GOP when you introduce another asset. I think when you expand the universe by something, by a new asset class that's not spanned by the previous asset.
Yeah.
And that's really something where you can make the even stronger arguments than the ones that you've already been making for these wine investments in actually more clearly demonstrating how it actually impacts existing optimal portfolios and how it adds value. And actually it will also potentially change the relative ranking of the various indices and how they actually contribute and what you need to look at. So when you're looking at just a Sharpe ratio, that's not really the relevant measure. What matters is what this new asset class contributes to diversification. And that's not, and if it's actually negatively correlated, it's even better than being orthogonal, being independent. Independent gives you, testing that gives you further diversification.
Yeah.
And then expand is outside the span of the existing asset class. But negatively correlated is actually inside the existing span. However, it's a great hedge, which means that potentially there, even if the returns are low, if it's negatively correlated with the rest of the market, it's a great investment.
No, definitely. I didn't explore putting. I only construct a global optimum portfolio using the wine only, but maybe something that I can expand it. Like what you said, yes, I agree that I'm shrinking the market by using the GOP only for wine only. Something I can explore.
Yeah. And actually, that then implies, right, that looking at how much do does this new asset class actually improve standard accepted optimal portfolios? I think there's a great story to be told there.
I'll definitely do that. Thanks for the comments.
Extra index. So this is like a repeat sales.
Yeah, it includes repeat sale and also hedonic, meaning considering the types of maybe the vintage, the cultivar or the region and so on. Yeah.
But I was just wondering because I mean wine, okay, we have a vintage every year.
Yeah.
And then I think they probably deviate. I mean, some years are very good.
Yeah.
So how is that kept, or would it play a role? Or I'm just wondering.
Okay, from the
are you changing the? But you're not doing what the NITheCS 100
No.
Because they are just choosing 100 wine.
Yeah.
That matters probably more.
No.
Have you're taking the entire sales of these top 10?
Yeah.
And maybe it's not that important. Maybe I should withdraw my
because I mean NITheCS, they don't even just they only consider be like wines that are in the top, then just take an average of those. Yeah, but what we're trying to do, we want to track the repeat sale of those wines, and then we also consider like the vintage into account.
But why repeat sales and not just the total sales or profit of these companies?
So because of the methodology for that have been widely applied is the repeat sale to create up an index from the academic space. But now we wanted to make sure that we advance that by looking at particular information about maybe a particular wine farm or maybe a particular region or maybe say Western Cape. Then we average those within the region. And then we also take into account how many of this wine has been resold.
Well, it's the resale value that matters, right?
yeah.
If you invest in them, what matters to you, whether you can sell it again.
No. No.
For instance, in the equity space, they will have few indices.
Yeah.
Right? So, and but is there a way? I mean, like somebody can come up with the alternative if they want to do that. So,
Yeah.
but what will then make the investor pick one versus another? Generally?
Because I mean, we were looking at which one this index in South Africa are top performing. And then we just look at a few and then we compare to this. So yeah, anybody can actually create up their own. Yeah.
It's just like you need to be careful that you have the data to manage that.
Yeah.
I mean,
Yeah, definitely.
otherwise you will get to the point where you can't.
Yeah, definitely. Yeah.
So your bond line is actively managed.
Yeah.
So will it have a tracking mandate based on your index, the way you
Yeah.
constructed it?
Exactly. And that's what we are doing.
So, but there won't be a perfect replication, right? Because it won't be investing in exactly the wines and exactly the proportions that your index comes up with.
But they also established, they came up with an automated algorithm that the one in the top 10, actually, if they're not performing, they take it out, and then the next one was in line will become part of the top 10. So they sort of tracking. Yeah.
One more thing, if I may,
Yeah.
I have a point, because it was interesting to hear in the beginning, right, that you deliberately excluded the most valuable of the South African wines,
Yeah.
right? So kind of called black.
Yeah, yeah.
And that may take you further away from the LiveX in a sense, right? Because the LiveX, those are really the top and most expensive wines for all of it. That's why only Penfolds Grange from Australia is in there, right? If Penfolds Grange, I think, might be the one in Australia that if you constructed the index, you didn't exclude it, right? For the same reason that you're excluding Cannon Black. And perhaps it might be worth revisiting that, either looking at what happens if you do try to put it into the index, which might stabilize it, make it more like LiveX.
Okay.
Or alternatively, just make it a separate investment. Right? So you've got your index, so you've got the Cannon Black, and you've got everything else. Right. So if an investor wants to invest in the South African market, it might actually be better to take the two separate.
Yeah.
Right.
But the problem with that, not many people buy. So the liquidity is not
Okay.
Yeah.
Oh, and well, it's, I guess, also a volume issue, right?
Yeah.
More than anything else.
Yeah. I remember we went to Rio de Janeiro, then we sat at one of the restaurants. Then, because I mean, we just arrived that day to Rio, we didn't know the convention. I mean, we didn't know how they use points or. So we went to this wine restaurant. We ordered a bottle. We thought it was just somewhere in 100, and and then we opened the bottle. I finished. It was a 2010. I finished it right. It was a very nice wine. And just when the waiter brought the bill, it was about 33,000 South African rand. Then I check in my wine index. Actually, it's actually in the LiveX 100.
Wow.
Yeah. Yeah, no, but it was just a surprising, but yeah, it was very nice. It was called actually Saskam. Yeah. Yeah, but it was very nice.
That price should be, right?
Yep. Yeah. Then if no question, then over to you.
Oh, yeah, but that one. You have Vegas city?
Sorry? No, I don't need the USB. I will use this. I use my laptop. Okay, all right.
Get the USB.
Right. Actually, recognition.
Oh. Our next speaker, Gerard. Yeah, we're going to talk to us about an efficient calibration framework for classical cyber and graph cyber volatility model.
Good afternoon. So this is part of my research towards my master's. I'm being supervised by Prof. Afias. Yeah, so I'll just walk you through the background, a bit of background, and then we'll discuss the classical server and particularly the function, the function that we're going to calibrate. And we'll also introduce the RAP server, and we'll follow an approach that was proposed by Fukasawa and Gatero. And we'll calibrate that function as well. And then we'll look at, we'll do the calibrations on 3 different frameworks that I'm going to introduce a bit later. And therefore, we'll move to the results from those calibrations and a bit of discussions. And that'll be it. So a bit of context. The interest in volatility models is because we have got a prevalence of derivatives trading in the financial markets. And in particular, this was, I think, the groundbreaking work that was done by Fisher Black and advanced by Poskos and Melton. We are able to value options using the functions that I've given at the top. But one of the major inputs to the functions is that we need the implied volatility of the option to be able to price. So most of the other inputs to the model that we have here, they can be observed from the markets. And the cumulative distribution, the cumulative standard normal distribution, that one you can also easily get. But it is only the implied volatility that cannot be directly observed from the market. So obviously we need to have a way of being able to measure that or being able to approximate that. So what they did in their work is they assumed that the implied volatility is static or it is constant. It doesn't change for all options offered for a particular, say, index. It's the same volatility across the board. But post the global financial crisis, you can see that over there at the top right, it's just a plot of the volatility of a particular stock, options on a particular stock, but then across different strikes. You can see that obviously we've got different volatilities and we seem to have a trend. And this is what we're referring to as the volatility smile. Right? So this phenomenon required that now we need to revisit the assumption that this model does make that the implied volatility of the option is constant. Right? So in the second pen, the first one is just the model dynamics of the Black-Scholes model. And with that one, you see that the volatility component is constant. So we're trying to explain the dynamics of the forward process or the price process of the contract. And in the second, the innovations that now, part of the innovations that occurred in the literature is that some authors moved from the constant volatility to look at now local volatility models that sort of to localize the volatility to different, say, strikes to pick the dynamics that are portrayed in the smile that we have over there. So of particular interest to me in this study were the SABA model and the classical version as well as the rough version. So over here we've got the classical SABA, which is the stochastic alpha beta rho model. And you see that now instead of having the volatility as a constant, we have it as a function of time. And the second equation there is describing now the volatility process. And so now the two geometric Brownian motions describing the price process, the forward process and the volatility process, those are correlated by rho, as you can see over there at the end. But d1t and d2t being equal to rho dt. And in the case of the rough SABA, it builds on the classical SABA, but now with the condition now that the volatility process now, instead of looking at the geometric Brownian motion, it follows, look at a fractional Brownian motion. Right? So it does introduce what we're referring to as the Hess parameter, the parameter H, you can see at the bottom here in the solution. So, but at the same time, still these processes, this volatility process is correlated with the forward process. Okay. So this Hess parameter is actually one that sort of describes the roughness of the model. In the case of the classical SABA, it's more smooth. And with the case of the rough SABA, it's a bit more aggressive. So this measures between 0 and half, with the higher you go, as you're getting closer to half, mimicking more the behavior of the classical SABA, and as you're going towards 0, increasing the aggressiveness of the model. Right. So what we need is a direct link between now the volatility estimates that we would get with the classical SABA or with the rough SABA to be able to still obtain implied volatility as with the, so that we can be able to value contracts, so you can be able to value the options contracts with the Black-Scholes model. Okay, so for the case of the classical server, we're building on the work of Hagan and others that derived an approximate solution, an approximate analytical solution to the Saba volatility. And here is the we can relate the Saba volatility to the Black-Scholes volatility with this function that I'm giving here. And anyway, I just sort of compressed it because I was trying to write it in a way that would be easier to code. So when I was doing the calibrations, but these are the definitions of the components to that model. And that's the case when, that's a general case for strikes and forward values that we would get from the market. But for the case where we've got, or for the at-the-money case where we've got the strike being equal to the forward price, there's a variation that they also did provide, which is a simplified version that we have there at the bottom. Right, so the main goal that we want to do in the case of the server is to obtain parameters alpha, beta, rho, and nu that that gives us the smile that is observed from the markets. Remember, I talked about the smile earlier. So we want to obtain parameters that perfectly or that suitably models that volatility smile that is observed in the market. And so anyway, just a bit of definition of the parameters. The alpha parameters can be thought of as the initial volatility level, and it controls the overall height of the smile. And the beta parameter is the elasticity between the forward process and the volatility. So it controls how much the forward process influences volatility. And what we have is that when we've got a beta parameter that is closer to zero, we've got dynamics that are log-normal in nature. And then when we've got beta that is closer to zero, we've got a normal dynamics that are more Bakelier or normal in nature. And look at the correlation between the forward process and the volatility process. When we've got a negative correlation, it sort of points to having a downward skew in the smile. Right? Sort of have a downward skew in the smile, and when we have a rho value that is positive, it relates to having an upward skew. So from literature, the downward skew is mostly recognizable. It's mostly observed with options on or with equity derivatives, whereas the upward skew is mostly observed with rate derivatives. Right? And now the final parameter, the nu, it's just the volatility of the volatility. And this does control the curvature of the volatility surface. Right, so moving on to the RAP server, like I mentioned earlier, we're now basing on the work by Fukasawa and Kathero, who proposed an approach to model the or to get the link between the black implied volatility and then the RAP server volatility. So the major innovation was that they were able to derive this ordinary differential equation, particularly for short, that satisfied normalized smiles, particularly for short maturities, by changing the dynamics into an equivalent martingale measure. So you can see that in the previous case we had alpha t ft to the beta, but now we have it as a function, as a beta function of ft, which still ranges between 0 and 1. So we'll be looking at maybe b of 0 or b of 1. Right. So what they did by doing that is that now the dynamics changed, and then working in that now equivalent martingale measure Q, they were able to, now the question was now to solve this problem, this ordinary differential equation that they obtained. And to do that, they based their work on results that I think the other authors, did I mention them here? Yeah, they use an approach that was suggested first by Balance in 2006. And that approach was able to give the general form. Then they also used the results from local volatility models work that was done by Beretsky and other authors in trying now to solve for the function f of y that is the solution to that differential equation. Okay, so to actually do that, what they did is they were able, they first had to change, they realized that they had to change the differential equation to now recast it in terms of a function g of y, which I've defined here as y over f of y. And then with that function, by squaring it to get another function capital G of y, they were able to find solutions to this differential equation, but only at h equals 2, sorry, h equals 0 and h equals half. So they were able to get the solutions at the extreme ends of the range of the Hess parameter. So what they did, yeah, so I've given the solutions here. They also just sort of compressed it to make it easier to quote, but this is what the H is referring to and the J in the solution there. So what they did now is, since they have the solutions for H equals 0 and H equals half, what they did is to now approximate the solution in the whole range of H values by interpolating in between the two, in between the two explicit solutions that they found. So by doing so, this is what they ended up getting as now a general solution, G of A, which leads to the solution of f of y here. Right? So obviously, it satisfies these two solutions when h is half and h is 0. Yeah. So the main output from the work was this formula, which anyway, the name of the paper is a rough subformula. So f of y is given by that function, modulus of the absolute value of y divided by now the square root of the solution that we have over there. And it is this function that we sort of used to calibrate the rough subparameters. Okay. So anyway, I've mentioned the other parameters here would be, we also have 4 parameters in this particular case. We've got the eta, beta, rho, and h. Beta and rho are, as I explained earlier in the when I was talking about the classical saba. And here the new parameters I think are eta and h, where the eta is just a shape parameter and h can be thought of as a roughness parameter. I think I also mentioned that a bit earlier in my presentation. Right, so yeah, now moving on to the actual calibration. Maybe before we get there, I can mention that we used options data to calibrate the model parameters to calibrate for the 2 models, and these are co-options on the Apple stock, and the data had 18 majorities, 18 different majorities, because it was presented in days, so we had to change them to the proper units, to years. So maybe you could see that the numbers don't make sense, 0.01. But anyway, that was referring to 4 days, but we had different majorities spanning over 2 years. And for each majority, we had about 51 quotes for different strike values. And so you can see here that we've got, on that particular day, we've got the forward price at 167.36, but the strikes have got a wide range of values. Right, so we considered 3 different approaches, in terms of the calibration. The first one was treating each maturity differently, calibrating per maturity. So obviously, this captures the maturity dependence of the models, but then it sort of just memorizes what is happening for that maturity, and it doesn't give us much information. And in essence, it does overfit. And by doing it per maturity, it meant that we are getting, say, for each of the models, we're getting 4 different parameters for each of the 18 different maturities. So we had a lot of parameters. I think it was about 72. So we're only using that now as a benchmark. And we also considered the global framework, where now we're trying to obtain a set of parameters that is maturity independent. And so this gives the benefit of this is that it would give us a more parsimonious model, but at the cost of losing accuracy in terms of modeling the smile or the surface. And another approach that we looked at was the semi-global calibration, now trying to get the both from each of the 2 approaches that I've already mentioned. So this does allow some of the parameters to be globally calibrated and some to be allowed to vary with maturity. So in that case, we tried to model some of the parameters. Like in the case of semi-global, it's the alpha parameter for the Saba model that we allowed to vary with maturity. And for the rough Saba, it is the eta parameter that we allowed to vary with the maturity. And we used a log polynomial function for that. Okay, so this presents the results of the maturity dependent calibration. So obviously you can see that the rough Saba model is actually able to capture the smile much better than the Saba model, particularly in the short maturities. But you can even see that it's even doing good at very high maturities or at very low maturities. But obviously, since I already mentioned that each of the maturities is having a different set of parameters, so that could be largely attributable to overfitting. But like I mentioned earlier, that we need to now look at a model that can better generalize while still maintaining the properties that we want. And so I think for the rest of the presentation, I will be more focused on the global framework and the semi-global framework. Okay, so in the global calibration framework, like I mentioned earlier, that we only had to find one set of parameters for each of the models. So I've summarized them at the top there. And you can see that even in that case, the rough Saba model, which is in red, was able to capture the smiles much better than the counterpart, the classical Saba, and most notably with shorter maturities, because we've got T01 and T0.01 and T0.11. But you see that even at higher maturities, it tends to fail. But anyway, that could be explained because the dynamics that the differential equation that was obtained by the authors was only satisfied for short maturities. So that can be explained. And now at the bottom, we have got the results from the semi-global calibration framework, where we expressed for the Saba, for the classical Saba, we expressed the alpha parameter as a log polynomial. So we had a log polynomial of degree 2, and we obtained those parameters. Now, being able to reduce the parameters from 72 to now having 6 parameters. Right? Because obviously in the case of the global calibration framework, we have got 4, but you can see that we are, like I mentioned earlier, there's a trade-off between having a simpler model and being able to accurately mimic the smile. So you can see that even at time equals 1.1, the rough Saba model under the global calibration framework does a bit of a better job than was the case when we did a global calibration. But still not as good as it is doing for the short maturities, the obvious reasons that I mentioned earlier. And now moving on to a closer look at the model performance. Here I plotted the volatility surfaces. So what we have at the middle here is the market volatility surface. You see that it's the volatility is spanning up to what 4.0, but you can see that at least in the case of the rough Saba, the shape is able to be mimicked way better than is the case with the rough Saba. You can see that this and the other plot in the same color is or in the same gradient is the Saba, and the other one is the rough Saba. But obviously on this side, we've got the global calibration framework, and on the other side, we had the semi-global calibration framework. So you can see that here, even though we're going up to 4, but here it's not doing good in predicting, especially the high volatilities, which are observed for short maturities, and as well as the very low strike prices. So at the bottom here, we've got now the errors. We plotted the errors. You can see that this is observed here, that even for all of the models, we've got they're lacking, especially for short maturities, but and short and small strikes. We would expect to have 0. If the model was able to perfectly capture the dynamics, we would expect to have a 0, a plane across this, a plane on 0 volatility, on the 0 volatility axis, but that is not the case. But still, you can see that the rough Saba seems to be doing much better than the classical Saba, and particularly when we are in the semi-global calibration framework. Right, so more on the performance. Here we just plotted the errors of the classical Saba and the rough Saba on the other hand. And here is when we're using the global calibration, and the second one is when we're using the semi-global calibration. And you can see from the scale, from the span, in the classical Saba, they span a wider range than in the rough Saba. Yeah, than in the rough Saba. And when you consider the rough Saba itself, you see that they are at least a bit more centered around 0 than when we're using the semi-global calibration than when we're using the global calibration, because we seem to be centered on a positive value, maybe somewhere around 0.1. Okay. So to quantify the performance or to quantify the performance metrics, I use the root mean square error, and so the coefficient of determination R squared, and you can see that what I'm referring to as just Saba is the one that we used maturity dependent, that we calibrated in the maturity dependent framework. Obviously, this would give the best of the returns, sorry, the best of the metrics, but like I mentioned earlier, that we're not focusing on this because of the over parameterization or the overfitting problem that I mentioned earlier. But you can see that moving on from a root mean square error of 0.126, it jumped to 0.2 for the global calibration framework, and we're able to reduce it to 0.224 for the semi-global framework. And in terms of the coefficient of determination, You see that we are moving from 91% or about 92% of the variation being explained by the model when in the case of the maturity dependent framework, but that is drastically getting reduced when you look at the global framework and even the semi-global framework. But now when we look at now the RAP-SABA model, we see that almost on all metrics, it's outperforming the classical SABA model. And in terms of the coefficient of determination, we're only losing out from 0.98 to 0.97 but the benefit is that now we are moving away from having 72 parameters to having only 6 parameters. So we're still preserving most of the variation that is being explained by the model when we're in the semi-global calibration framework. And when we're in the global framework, and still the same can be applied, or the same can be applicable when you look at the mean square error values. We've been able to reduce it in the global framework from 0.09 to about 0.07. So this is the end of my presentation. I'll welcome questions.
Questions? That one?
Thank you, Gerard, for that study and for the next presentation. I have a question about, okay, you showed your next table, a table that has the root mean square errors. So I'm just wondering whether your objective function, I mean, the way you define your objective function is related to this table in any way.
Okay, so my objective function, I was trying to find a parameter set that minimizes the difference between what my model is outputting, my model outputs, and the market observed volatility models. The market observed volatilities, the codes.
So that is least squares.
Sorry?
Is that the?
Yeah.
We are doing least squares.
Yes.
Okay. And then this is the root mean square error.
Yeah.
Okay. Maybe it would be more informative to have a table that reports calibration errors. Because when you are moving from these terms, from this setup with term structure parameters, you move to semi-global, and then you move to global. You are achieving parsimony, but then you are losing something. You lose accuracy. So if I can have a table that shows the calibration errors in all the 3 cases, that is more informative for what is going on. But also the other ingredient that would be good for the table is because you have like you have many codes, maybe over you have hundreds of codes. I would report it using quantiles. Like if I have set the mean calibration error, maybe median, lower quartile, upper quartile, like that. That's just a suggestion. I don't know whether you have done it already.
No, actually, the computation of the errors have already done that, but maybe some of I haven't looked at I haven't evaluated the errors using, say, quantiles and whatnot, because even these plots, they were using those error information that you're talking about. The table is there, but maybe I just didn't include it here.
Any other question, Eric?
Yeah, so Nelson's suggestion it's a very good one, though I wouldn't throw away these plots, right? So they're very nice graphical visualizations already. Now you calibrated to the mid, right? The mid price.
Yes.
Do you have any idea what the size of the bid-ask spread is on these products?
Sorry?
Do you have any idea of the size of the bid-ask spread on these prices that we're calibrating to?
I could get it, but I just didn't have any idea of what maybe to do with that.
Oh,
But I do have that information.
Yeah, it's very important, right? Because the market doesn't tell you the prices exactly. Right? It tells if you're using the mid, that is not necessarily the true price, right? Because all the market's really telling you is that the true price is somewhere between the bid and the ask. Right? So if you're aiming for the mid, you're aiming for too much, right? Because the market has this ambiguity, and you can actually use that, and it should actually only count as errors what is outside of the bid-ask spread. Of course, that depends on whether you can get the data for it. But if you can at least get the size of the bid-ask spread and have the mid, then you can just artificially construct your bid-ask spread around the they have. And then I mean that'll just make your results a bit more practical, right?
Oh, I see. So if I get you correctly, maybe you would want in my plots to have a range here. Now that is because now these are the mid values,
Yeah.
but I should have
Yeah. So
the spread.
Yeah,
They should be inside the spread.
If your green line ends up between the range, right,
Yeah.
then you've got.
Oh,
actually got
okay,
perfect
yeah,
data,
yeah. That's
right?
actually quite good.
And the other thing that you're seeing there is that especially there up in the left-hand corner, right? That the market prices that you're getting, they're most likely some stale quotes prices in there, because it's unlikely that those dots, the way they're shaped, especially up in that corner, in most of these plots, right? There are probably not many trades going on, so you're going to get stale prices, and that means that actually the market isn't giving you exactly that information, right? It's an artifact of fact the quotes are stale, and the fact that your model can't fit that is not a problem for the model, right? Because so that's if you can get actually some more timing information, it depends on the market. From when those quotes are, sometimes they can be days old.
Yeah. Right, thank you for that. Yes.
So let's say so we basically use the simplified version that was designed for short maturity.
Yeah.
But all the way to the 2 years. Is that just or?
Yeah, I think for me it was just an experiment to just see how it does.
Okay.
They said the OG is satisfied for short maturities, but I was just trying to see how it would do for the longer maturities, even though at the back of my head I still had.
What was short in the paper? I mean, what do they consider as short? Is that like
Sorry?
the author of the paper, what
Yeah.
do they consider as short?
I
mean, the ideal.
The ideal short.
Mhm.
I think, yeah, I think it was about half a year, up to half a year.
So, but it's still possible to just use the non-simplified version, but solve for all the maturities. Except it's maybe harder. I mean, like you need a solver. I mean, like if you don't want to use the ODE, and then we go directly.
Okay, the problem is if I go directly now, there's no sort of approximate formula for it. It means that I would have to do Monte Carlo simulations, which I think most of the literature, it has already been done using Monte Carlo simulations and the like.
Okay, well, that's, yeah, well, we can, we're trying to use PDE directly for that, and I'll check that later on. Then I think answer the question of the range. I think I'll point out, you're going all the way to 75. Is that your moneyness?
Yes, yeah.
Okay, so maybe one way is also to just weigh them less, like those extreme points are less accurate, and the spread is probably bigger there. Then one way is to just reduce the weight, or so like focus on the middle.
Okay.
I mean, but
like I should reduce the range and just focus on near at the money.
We use a weighting scale, right? So you weight more in the middle than you weight on the wings. I mean, I don't know if
Right, I will consider that. It's not coming to me how I would go about it, but I would
It
definitely
has
look
to
into
be
it.
the objective
Yeah,
function.
yeah. Sorry?
It has to be in the objective function. The one that you are minimizing, all that
Yeah.
information can be fed into.
So I should weigh closer to at the money more than. Right.
nice problem.
Well, and then another way to that you could address the possibility of these clearly still plots that are going off and right, is to look at static arbitrage relationships in your volt signals. Right, so some of those dots that you've got there, they are going to represent actual arbitrage or static arbitrage opportunities. And there's a very nice paper by Sam Cohen with some co-author about arbitrage repair of the ball surface. And if you that might be worth applying and then seeing how well you fit in. Because no model, no arbitrage-free model is going to be able to fit some vol market data that has started static arbitrage in it.
What paper is that? Maybe I should just take note of it.
Yeah, knows what I'm talking about.
Okay, all right, okay.
Fine.
Yeah, otherwise, just see send me an email.
Okay, no question, let's then. Okay, for lunch, we just got to know it, then, yeah. Go to any shop that you want to. Back here at 2, so that we have longer afternoon. Then we'll meet at good environment 17. Oh, 19, sorry. Yeah, of course.
Good job. Perhaps initial parameters.
Sorry?
But how do you choose your initial parameters?
Initial parameters?
It doesn't matter.
No, that's actually.
Go around that.
The theory would be.
How does it? An extra screen. Especially if you're going to code, you can. There's a lot of there's more shit. Supervisor.
No, man.
Next one.
Yeah. Is it going to work?
So he was just thinking about stuff members. I was just asking him if you LHS.
Oh.
Alright.
Is your.
Which group? You went out.
You see life. During my
Yeah, but that was, yeah, the minute, only the league means the person is. It's like, if I say, if I don't want to send you, I say, you don't want to send you, I say, how much you buy? Say, you can do it like, you know, you do it, yeah, I don't do it, so, no one is, you know, so you now can, oh, you know, we can use.
But very nice to meet you in person. Yeah, no, thank you very much. Thank you. Right. And does everything work? Yeah, because you're one of the first workshops that we host here.
Yeah, everything is working,
Okay, okay, nice.
been recorded.
Excellent.
Yeah.
Wonderful. Okay, then good luck for the afternoon.
Okay.
Maybe you can have a coffee just now.
Yeah, coming just from China.
Nice.
So.
Oh, Messias. Must I use this computer?
Yes. Oh, yes.
Can I use this flash drive?
Which one?
The flash disk that is here.
Okay, that's what, yeah.
Have a pointer, NITheCS.
No point.
To pay first. The commission. That's more than you. You guys disappear too. You guys disappear too. No, I mean for your lunch. You were there, they were just sitting down there. What did you eat? I told that we eat after the finish. We'll buy when we go that side. So we didn't eat. When I was doing the data for I did the temperature maximum and minimum. But when I was doing the rainfall, I realized that it's missing. They only gave us from 1990 to 1995. Yeah. Informed them I requested, hopefully they will send it.
So like I said, the last thing out. Long after. Open all questions. Yeah.
No problem.
All others. Yeah, so, yeah, so, next thing is Nelson, we're going to talk to us about field planning, information, only have to look, but what we follow. How about you?
Thank you, Chair. Good afternoon, everyone. So my talk is on filtering and estimation in parsimonious mixed Bergomi models. This is part of my PhD work. This research is still ongoing. And the title you are seeing here is not the final one, still a working title. Maybe it will change when we finish the study. I'm happy to present to you our results so far. It's joint work with my supervisors, that is Messias and Eric. The models that we shall be working with are called parsimonious mixed Bergomi models. So there are two. We shall call one of the models the one-factor model, then the other one called the two-factor model. These are models that we've developed during my PhD studies. But then the talk today is not on model development. Rather, it is on designing filtering techniques in these models. So the model development was done in an earlier paper. What do we want to do today? In a nutshell, we want to set up what we call the uncentered Kalman filter framework for our models. In any filtering technique, we usually have what we call measurements or observations. So our measurements will be fixed features and the options. And then we shall be doing two things only, actually. That is the state filtering and the parameter estimation, as we will see. The results I have today are validation results. So we are validating our framework, the framework that we build. We are validating it in both the one-factor and the two-factor model. We are using simulation data to do that. So what's the goal for today? The goal is to set up a state space formulation to recover the model structural parameters and the latent states. As I said earlier, we shall be doing that using simulated data. Now, the filtering technique we use is the uncentered Kalman filter, which we are calling UKF. Why do we choose the UKF? There are a few reasons, but the major reason is that, okay, it's known the UKF is one of the techniques that can be used, the filtering techniques that can be used to handle non-linearities in models, like non-linearities in a pricing formula. But then there are other filtering techniques like the extended Kalman filter. I think the commonest two are the UKF and the extended Kalman filter. Of course, there is Monte Carlo. But then why are we choosing the UKF? There is a general consensus as the UKF is more accurate than the extended Kalman filter. And the other thing about the UKF is that it is easier to implement compared to the extended Kalman filter. In particular, in the UKF, we don't compute what we call the Jacobians. In many models, computing Jacobians can be challenging, and it's a challenge that you face when you use the extended Kalman filter. I have this diagram here. It's not my diagram, got from this paper. On the left-hand side, that's my left, this side, this part. So we've got, here we have the mean and the covariance. This is for state mean. The state is X. So this is the state mean, and this is the corresponding covariance. So the state mean is being propagated through this function f to produce y on the other end. So here we've got what we are calling the true mean, the mean of y and its covariance. So in the middle, the extended Kalman filter is being used to estimate whatever is going on here. Then on the far end, we are using the uncentered Kalman filter to estimate what's going on here. So you can see that the extended Kalman filter fails to capture the true mean of y. True mean is here, but then this approximation from the extended Kalman filter ends up here. So it fails to get it precisely. Now, remarkably, when you look at the UKF, the uncentered Kalman filter here, it captures it. There are two circles here that are close to each other. So the UKF has captured the true mean of y. And even when you look at the covariances, the covariance in the case of the extended Kalman filter, first of all, is big and it takes a different direction. But for the UKF, the estimated covariance as estimated by the UKF is closer to the true covariance. So this is what I mean when I say that the UKF is more accurate. Now, I should take you through the models. We have the one-factor model and the two-factor. So the one-factor model is simply what we are seeing here. I'll take you through the different equations. The first SDE, this is the Einstein-Uhlenbeck process, the standard one. And it's the driver of the dynamics in this model. One important thing that we should put in our minds about this model is this equation here. So we've got psi t, small t and capital T. Now this capital T is contained in this interval where we have t plus delta. So delta is the 30 calendar days and the small t is the VIX futures maturity. As I said earlier, the measurements will be VIX futures and the options. So this psi t will be called the forward variance. We'll talk about it in more detail later. But it is defined in this model as the product of what we call the initial forward variance and this function f. So you can see that all these terms are dependent on capital T, which capital T is contained in this interval. Then this function f is just this decomposition that we see here. I will talk about gamma. Gamma is one of the model parameters. But again, you can see that gamma is a function of this capital T. And then this is an exponential with omega, which is also a parameter. Another exponential here, nu, which is also parameter. And then we've got the function h and this term x. So I define the function h and the term x, small x, then it's this side. So h and the small x are defined like that. They're just deterministic terms. Nothing is strange here. Now, one thing that so this is a new model. This kind of setup is new. But one thing that we've used in building this model is that we define one of the model parameters omega using a linear combination of two exponentials. These are decaying exponentials. And when you look at, for example, this omega, we said that this t should be contained in that interval. But to simplify our modeling framework, we set t to be equal to little t, such that when you plug this t into omega, you get one value of omega for each interval from t plus delta. So it's the model. You could allow t to move in that interval freely. But it's a simplification we introduced in our model. We use a smear reasoning for gamma, and gamma is just a logistic normalization of omega. But we defined them this way because we wanted to capture what we are seeing in the market. The two-factor model has smear dynamics with the one-factor model. The only difference here is that now we've got two drivers here. We've got two Einstein-Rambeka processes. So this J is in that set 1, 2. But the rest of the definition is, the rest of the terms are similar. Of course, because it is a two-factor model, things like a correlation between the two oil processes have to come in. But in structure, it is the same setup. Let's get into the data that we work with. As I said, we are working with VIX futures and options. But before you get into the derivatives, let's understand what the VIX is. Now, before you understand the VIX, we should understand what we call SPX. So SPX is the ticker symbol for the Standard & Poor's 500 index. We know this. Now, VIX actually is an abbreviation for what we call the Chicago Board Options Exchange Volatility Index. Now, in the almost plain language, in the simplest language, the VIX is the expected annualized volatility of the S&P 500 over the next 30 days. So if the VIX is 20% today, the interpretation is that over the next 30 days, the market expectation is that the S&P 500 will move by a level that is less or equal to 20% with a probability of 68%. This VIX is often referred to as the fear index or fear gauge. This is just a time series of a plot of the two time series from 2004 to, I think this is 2023. So blue is the SPX, red is the VIX. Something that we see here is that there is sort of a negative correlation between the two time series. So when the SPX falls, that means stock prices are falling. So there is fear in the market. The fear must go up. That's the VIX going up. And the reverse happens. So it is something of the sort, but it doesn't happen all the time. For example, if you have to go back 20 years, you find that if you have to look at the level of SPX 20 years ago, maybe it was, say, 10 USD. Currently, I don't know where it is, maybe say it's at 5 USD, 5,000 USD. But then the VIX has not been decreasing monotonically. The reason is that this VIX is mean reverting. Of course, you can select two moments here when it went up. This is during COVID, and then this is during the financial crisis. Now let's go into the technical definition of the VIX. Now what we shall use in our modeling. So the VIX at time t, small t bigger than 0, is the implied volatility of the 30-day logo contract on the SPX index starting at time t. Now this statement translates into this equation. What's happening here is that we are saying that if you compute, this is the logo contract. Yeah. We are saying that if you price the logo contract and scale it by this factor, what you get on this side is sigma squared. The black shows implied volatility, but squared. In the end, you'll have that VIX squared is equal to sigma squared, and VIX will be the sigma. So it's the implied volatility of that 30-day logo contract. In practice, the CBOE computes the VIX using this formula. So it's the Kalman-Daniel formula. It's not used in this form, it's usually discreted before it is used. But we're not going into those details. These are liquid instruments. But one thing we should know is that the VIX index itself doesn't trade, just an index. But the futures and options are highly liquid instruments. Here you look at the daily average trading volume from 2001 up to 2023 and see these numbers are big numbers. This is 10 to the power 5. So let's get into the derivatives. How do we price VIX futures and options? In a forward variance model, this definition holds. So the models that we work with are forward variance models. So the forward variance is this xi. So VIX squared is simply that integral. What is this xi is what we defined at the start. So the options and futures are obtained using the classical formulas, and that's for the futures, the time 0 futures price for maturity small t is simply these expectations. And then this is the formula for computing the odds. So our two models have these parameters. The one-factor model has 14 parameters. The two-factor model has 19. Let's get into the state space formulation. So here we are getting into the uncentered Kalman filter. But then in the end, we want to bring together the models and the filter to see what we get out. So of course, in any state space formulation, we shall have what we call the state equation and the measurement equation. So the states will be our OU processes. So like here, the state at the nth time step is simply defined like this. It's the two-factor model, xn, the both phi's, xn will be this transpose. Because we can reduce this one trivially to a one-factor model. The other terms are defined like this. So xn just simply means the state at the nth step after the start. So here we shall be moving through calendar time. Then the measurement equation will be like this. So we've got the left hand, the Zn, and then this H. H is a function of the state and the parameters. Now, this H is my model. It's what comes from the model. So the issue here is that Zn is from the market. So what comes from the market is equal to what comes from the model plus some idiosyncratic term here. And this Vn is defined like this. On average, in the simulated data that we work with, this is Zn is a vector of size 89 on average testing. I need to show something here. Maybe I should move this thing. So this is something we use in our modeling to bring the prices to comparable scales. We do some scaling here. If you look at the VIX futures and the option is the cause, these two instruments live in different scales. So what we do, instead of working with the raw prices, we instead work with log futures, log future prices, and we scale the options by their Black-Scholes-Vega. The UKF in a nutshell. I don't have the equations of the UKF here, but I can tell you about the steps that we've got to go through to use it. So the purpose will be to estimate the state. Okay, this, with my notation here, X and N, I'm meaning the value of the state after taking the observation for that day. The Bayesians will call it the posterior that day. So what are we doing here? We are predicting the linear state. If you look at our equation, the state equation, this equation is linear in X. So to use this, the Kalman filter on this equation, we just use the standard Kalman filter on the state. However, when we get to the measurement equation, this part is highly nonlinear in X. You remember the other explanations that we had? Those are linear hormones. So what we do is that now we use the uncertainty Kalman filter. And what does the filter say? We say that it says that you generate sigma points. These are the sigma points, which are propagated through this nonlinear function, the F now. And using deterministic weights, we can predict, we can calculate the measurement. That's the mean and the covariance. So we can end up here. And then if we end up here, usually the last point is to update the state on that day. Then we evolve and go the next day. Okay, now we've gone through the filter, we've gone through the models. So we should bring them together and see what happens. What we did here, we simulated data for 5 years. That's about 1 to 60 trading days. So on each day, we have VIX maturities. We have about 11 VIX maturities, moving from 10 days to 270 days. And in total, we have about 120,000 prices. So we run the UKF on the scaled prices. The output of what we are doing here is one, the daily state estimate, and then two, the parameter estimates. And we estimate our parameters via maximum likelihood estimation, of course, after taking a few assumptions. Now, we get into the results as we conclude. Here, if you remember, the working title is filtering and estimation. So here we show that our framework can actually track at the state. So here we've got the true OU state, the simulated one, and then the mean UKF value, what's coming from our UKF framework. And you can see this blue and red track each other very closely. Our mean UKF values are based on 100 UKF runners. So we average across 100 UKF runners. For the two-factor model, a similar thing happens. However, the two-factor model In the two-factor model, the state is not as simple as what we see in the one-factor model, because in the one-factor model, all we have is this. And then in the two-factor model, we are taking this linear combination of the two oil processes to be the state, but then it turns out to be maturity dependent, because we see this T coming in here and this T coming in here. So now what we have plotted here is just an average of this small x over that interval. And you can approximate that using several techniques, but one of them is the Gauss legend, that's what we use here. We still have the average across 100 UK francs. Now, this is an ingredient we put in our maximum likelihood estimation setup. So what we do, because we've got two markets, we have the VIX futures market and the VIX options market. But then they don't have the same number of instruments. So we don't want our estimations to be biased towards one market. So we normalize. First of all, we split the log likelihood function is, and then divide by the number of instruments in each market. And then we add the average log likelihoods on each day. And then we maximize the sum of the averages. Now here, we show the results from our maximum likelihood estimation. They are very simple to interpret here. So this is the model parameter. This is the one-factor model. And then this is the true value. This is the estimated value, the mean across 100 UK francs, and deviation and mean standard error. So you can see that our floater retrieves the parameters that we use to simulate the data with higher trace accuracy. A similar thing happens with the two-factor model. These are just some of the parameters. Not all of them are shown here, but we have similar results. So what do we take away from what we've gone through? We see that we've set up a tractable and stable UK framework for our models. Using maximum likelihood estimation, we are in a position to recover the model parameters. And the state is filtered accurately. That's on simulated data. As I said earlier, this is the ongoing work. So at the moment, we are working with market data. A few things, of course, will change. Like the VIX maturity was kept fixed on the VIX maturities were kept the same across calendar time in simulated data, but here they will have to change. The initial forward variance will keep changing, things like interest rate will keep changing, but we hope to look into the in-sample and out-of-sample diagnostics, because we have compared the one-factor and the two-factor models. Then we shall have to look into other things like the price of risk. Thank you very much.
Yeah. Questions to Nathan?
Just a general question then. And I missed how you do your setup. In reality, when you are choosing when you are estimating, you have to start with a guess of the parameter. Because I mean, if you see the table, you saw how well, yes, So when you go with real data, how are you be guided on setting up those initial value as you start searching? I mean, it's another way of saying that with that number of parameter, how the issue will be stuck in some local solution when there's a global one, or you don't have that issue in this case.
Okay, thank you very much for the question. Actually, it is possible to get stuck in a local minima, but okay, to obtain these results, we are using a local minimum. We could use a global one, but we saw that the local one was retrieving the parameters.
With any guess, you know what I mean, right?
Okay, you mean okay.
You starting, how far? If I just randomly start, would you get there or?
Okay, so the initial point, the starting point was actually close to the true parameter.
Yeah, so that's the challenge.
If you start from far, I believe you are likely to. It is possible to get into some kind of trouble.
Yeah,
but we perturbed them a little bit. What we did.
That comes with the game.
Yeah, but thank you for that insight. I will try to start from and see what happens.
Yeah.
It's actually true, a good point, and we've discussed that. Yeah, and whether we should go with a global optimizer, which would help, right? And the tests that Nelson is now going to run in line with your comment, that's is a very good idea. The problem is actually even worse than that once you're going to real data, because if you have local optima, and let's say they are the magnitude is similar, then simple estimation norm is made to start bouncing you between different local minima, and that's real trouble, right? So there's actually quite a bit more on simulated data that one can explore here in terms of stability of the estimator.
I mean, we have that problem with regression all the time. So I thought you guys found a.
No, we are facing a similar problem, to that very problem in another study where we are doing the calibration.
Okay.
It's something that has taken a lot of our time trying to look at how the local optimizers are performing versus the global ones.
Any other question? No, thanks, Nelson. I heard our last speaker was not able to make it, so we have an afternoon to ourselves. And we meet again at the Cameroon at 7 o'clock, 19 p.m. So, yeah. So you have an opportunity to explore Stellenbosch.
Emails.
Oh, yes.